पद्मप्रिये पद्मिनि पद्महस्ते पद्मालये पद्मदलायताक्षी विश्वप्रिये विष्णुमनोनुकूले त्वत्पादपद्मं मयि सन्निधत्स्व या सा पद्मासनस्था विपुलकटितटी पद्मपत्रायताक्षी गम्भीरावर्धनाभिस्तनभरणमिता शुभ्रवस्तोत्तरीया लक्ष्मीर्दिव्यैर्गजेन्द्रैर्मणिघनखचितैः स्नापिता हेमकुम्भैः नित्यं सा पद्महस्ता मम वसतु गृहे सर्वमाङ्गल्ययुक्ता लक्ष्मीं क्षीरसमुद्रराजतनयां श्रीरङ्गधामेश्वरीं दासीभूत समस्त देववनितान् लोकैकदीपाङ्कुराम् श्रीमन्मन्दकटाक्षलब्ध विभव ब्रह्मेन्द्र गङ्गाधराम् त्वां त्रैलोक्य कुटुम्बिनीं सरसिजां वन्दे मुकुन्द प्रियाम् सिद्धलक्ष्मीर्मोक्षलक्ष्मीर्जयलक्ष्मी सरस्वती श्रीलक्ष्मीर्वरलक्ष्मी च प्रसन्ना मम सर्वदा वराङ्कुशोपाशमभीतिमुद्रां करैर्वहन्तीं कमलासनस्थां बालार्ककोटिप्रतिभां त्रिनेत्रां भजेऽहमम्बां जगदीश्वरीं त्वां सर्वमङ्गलमाङ्गल्ये शिवे सर्वार्थसाधिके शरण्ये त्र्यम्बके देवी नारायणि नमोऽस्तुते महालक्ष्मी च विद्महे विष्णुपत्नी च धीमहि तन्नो लक्ष्मी प्रचोदयात् ॐ शान्ति शान्ति शान्तिः
Om Shri Sairam. Sairam and good morning everyone. It is my pleasure to welcome you all to the one-day national workshop on the Indian financial system, prospects and challenges. To commence this important event, I would like to invite our esteemed dignitaries, respected Chancellor Sir, Director of the Prasanthi Nilayam campus, Head of Department of Economics, Rajashekhar Sir and Sanjay Sahni Sir to kindly step forward and light the ceremonial lamp symbolizing the enlightenment and knowledge we hope to gain today. Thank you, sirs. The Indian financial system is vital for economic development, supporting savings, investments, and efficient transactions while ensuring stability through robust regulatory framework. It has promising prospects driven by economic growth, digital innovation, and global integration, but faces challenges like non-performing assets and cybersecurity threats. Despite these challenges, India's financial institutions have remained globally stable and are crucial in achieving the vision of India becoming a developed nation by 2047. Up next, we shall have the welcome address by Head of Department, Department of Economics and Dean of Academic Welfare, Dr. G. Raghavendra Raju. Dr. G. Raghavendra Raju is an expert in the areas of international economics and finance, which is reflected in his numerous publications spread across modeling different aspects of the external sector. He is actively involved in research work apart from his full-time teaching duties. He pursued both his undergraduate and master's in economics, then went on to complete his doctoral degree at the Sri Sathya Institute of Higher Learning. After his master's in economics, he cleared the UGC NET and joined Sri Sathya Institute of Higher Learning as lecturer in 2003. Dr. Raju has guided PhD students over 60 dissertations at the Department of Economics as well as Department of Management and Commerce. He has published 2 books, about 10 chapters in edited volumes, around 45 research papers in refereed national and international journals, and presented over 60 papers in national and international conferences. He is invited as a research person of econometrics at various universities in India. He served as Assistant Director of the Prasanthi campus during 2018 to 20. From April 2020 to April 2023, he also served as the Director of the Prasanthi campus. Now, I would like to invite Dr. G. Raghavendra Raju to deliver the welcome stage address and also set the stage.
Om Shri Sai Ram. Offering our collective pranams at the divine lotus feet of our beloved Lord, Bhagavan Shri Sathya Sai Baba Varu. Esteemed Chancellor Sir of Sri Sathya Institute of Higher Learning, Shri Chakravarti Sir, former Controller of Examinations, Shri Sanjay Sahni Sir, the Director of the Prasanthi campus, Raghunath Sharma Sir, and esteemed guests, Rajashekhar Sir, and the adjunct faculty, Francis Oliver Sir, and my dear students. I welcome you all for this one-day national workshop on Indian financial system, prospects and challenges. On behalf of the organizing team, I also take the opportunity to welcome the directors of all the 4 campuses, the deans of all the faculties, the heads of various departments, the faculty members, the research scholars, dear students, and also all those who have joined us both physically and also virtually. A loving saram to one and all. Our warm welcome, especially to the 4 distinguished speakers, Shri Venkat, Bhargav, Sreedhara Sir, who is a financial sector specialist at the World Bank, Shri Sundar Murthi Sir, the Chief General Manager, the Department of External Investments and Operations, Reserve Bank of India, Mumbai, Shri S.K. Rajashekhar Sir, the Senior Portfolio Manager at the Reserve Bank of India, Mumbai, and our own Sanjay Sahni Sir, Associate Professor at the Department of Management and Commerce, Prasanthi campus. We extend our sincere thanks to all the 4 distinguished speakers who, despite of their demanding schedules, have honored our invitation and joined us to share their expertise with all of us. Before I get into the theme for today's workshop, it's also important for us to quickly look at the genesis of this department. This department is one of the youngest departments, started only in 2001, in the sense from post-graduation perspective. but the undergraduate programs were there since the inception of the institute. Way back in 2014, based on the feedback received from the different stakeholders, which includes the alumni, the corporates who employed our students, the employers, and then the students themselves, right, and also visiting faculty, we understood that economics and finance cannot be segregated as such, so we need to club them, and that's where we evolved a theme, what we call as the financial economics. So since 2014, we introduced this new stream of economics, namely the financial economics, and let me tell you that from 2014, it was almost every year that every student preferred this stream vis-a-vis the applied economics, because that itself will tell you the importance of financial economics in the current day context. In fact, in 2023, when the NEP was introduced at SIHL, we also made sure that we offer this BA and BS in financial economics. Why only MA economics? We thought we will also extend it to BA and UG programs as well. And next year, by Bhagwan's grace, we are trying to propose a BS in financial economics and data analytics as a course at the undergraduate level, again knowing the importance of data sciences. Since 2003, it has been an annual affair that the Department of Economics always has, a big event of this nature, either in terms of a conference or a workshop or a seminar. And from the last year, we have ensured that, in fact, to give a bit of history again on that, it was on 26th of August, 2006, almost 20 years ago, Bhagwan had inaugurated this very room, what we call as the Multimedia Learning Center, the art of, a room which can really help us to conduct these kind of sessions. And also Bhagwan inaugurated the Humanities building on the same day, 26th of August. So it turns out to be birthday of these two institutions or the buildings, I would say. And then we have proposed, and administration was very, grateful to accept our proposal that we would observe every 26th of August as what we call as the Arthashastri Divas. So from last year we have started that, but this year 26th happens to be Krishna Janmashtami. So it's like on the eve of the birthday we are trying to organize this one-day workshop. The planning for this workshop actually started almost about 2 months ago. But let me also state at this point of time that the planning was on, and we were thankful for the resource person to accept. But we were in a dilemma whether we need to have this session or not. For the reason that all of us are aware, one unfortunate thing, that is Professor Pandit. We lost Professor Pandit. He has merged with Bhagwan. So we really had a, I don't say ethical dilemma, but we were wondering whether we should really go ahead with this activity. But then I remembered Pandit sir's statement that never stop things which are good, especially for anyone. And most importantly, I'm sure wherever sir is now, I'm sure he's with Bhagwan, but he will never like to be stopped an event, that too because of him, which he will never like that. So probably that thoughts, we had a discussion at the faculty level, and then we all felt sir will be very happy if we have such events, and we should continue this saga. And the best part is always, it's starting is okay, but continuing is even more challenging. So this particular workshop, I would say, it is obviously in fond memory or loving memory of our Professor Krishna Pandit sir, whose light continues to shine in our hearts, and let his love and wisdom guide us every day, Professor Pandit sir. So coming back to the theme, I'm also here to set the stage for the workshop. So coming back to the theme, again, there's a lot of empirical evidence, there's also a lot of theoretical evidence that economics and finance, or financial sector or financial development is very, very important for economic growth and economic development. And lot of research has been done at this department itself, where we have a lot of publications also in peer-reviewed journals and UGC listed journals, where there's a high correlation between financial sector and economic growth. So knowing the importance of financial sector, and as I said, the genesis also why in 2014 we started this stream called financial economics. So it's important for us to quickly look at the status. The Indian financial system has witnessed remarkable growth and transformation over the years, contributing significantly to the nation's economic development. This workshop provides an invaluable platform to engage in insightful discussions, share the expertise, and gain a deeper understanding of the dynamic financial system that played a very important role in shaping our economy and that continues to play a very important role in shaping the economy. And one of the aim that we all listen to or we look forward is India achieving a $5 trillion economy. And I'm sure that the financial sector plays a very critical role in even achieving this particular objective. Our workshop comes at a very important time when the Indian financial system is experiencing rapid transformation. The system's evolution is influenced by many factors, from technological advancements and regulatory changes to economic shifts and global uncertainties. As such, it is imperative for us to engage in a thorough examination of these dynamics and also their implications. The Indian financial system has long been a cornerstone for economic growth. It plays a very crucial role in mobilizing savings, providing credit, and fostering investment. Over the years, we had witnessed significant strides in financial inclusion, digitalization, and regulatory reforms. These advancements have brought both opportunities and also challenges, shaping the current landscape in a very profound ways. That's the reason we want to cover both the challenges and also the prospects of this particular sector. These prospects for the Indian financial system are very promising. With a young, dynamic population, a growing middle class, and a robust entrepreneurial spirit, India is poised to continue its trajectory of growth and innovation. However, this optimism must be tempered with realistic understanding of the challenges that lie ahead. Issues such as regulatory complexities, financial literacy, and the need for sustainable practice require our attention and immediate action. As we gather here, it is crucial to acknowledge the unprecedented challenges that have been emerged in the wake of global economic shifts, technological advancements, and also evolving the regulatory frameworks. These challenges necessitate us to inform and have a collaborative approach to devise the strategies that ensure the stability, the inclusivity, and the resilience of our financial system. I urge all the participants and mostly the student community to actively participate in these sessions, exchange ideas, and contribute to meaningful conversations that can pave way to the innovative solutions and some of the best practices. The collective knowledge and experience within this gathering have the potential to foster positive change and empower the financial sector to overcome obstacles and seize the opportunities for a very sustainable growth. With these few thoughts, I end my talk, and I once again welcome you all for this one-day national workshop on the Indian financial system, prospects and challenges. Thank you. Jai Sai Ram.
We thank you, sir, for highlighting the history of the department as well as bringing ahead the importance of the financial sector for India's goal to achieve $5 trillion economy. For the first special invited lecture, I would like to invite Shri Venkat Bhargav Sreedhara. Shri Venkat Bhargav Sreedhara is a financial sector specialist with the South Asia team of the World Bank. He works on developing financing and technical assistance projects across financial sector issues such as climate finance, MSME access to finance, housing finance, Fintech, and others. He has worked on several large projects with the Government of India on green hydrogen, climate finance, and MSME financing. Previously, Shri Venkat worked with Reserve Bank of India on financial regulation and supervision for banks and NBFCs, and with the Ministry of Finance on supporting the finance track during India G20 presidency in 2023. He shall be speaking on Indian financial system, recent developments, and way forward.
Thank you. Good morning, everyone. Thank you so much for this invitation. First and foremost, I hope I'm audible to everyone.
Yes, sir. Yes, sir. Thank you. Yes, sir.
Thank you. No, good morning to everyone. Thank you so much for this invitation to speak at this important event, to speak at this national workshop. Uh, what I will do over the next 40 minutes or so is just take you through my brief presentation on what's been happening in the Indian financial sector, how we see it, and what are the recent developments, opportunities, challenges, and the way forward. I'm now going to share my screen with my presentation. Let me know if you can see it. I hope you can see my screen.
Yes, sir. We are able to see the screen.
All right.
Can you
Great. Thank you so much.
can you switch on the slide mode, sir?
I've put it in presentation mode. Please let me know once you can see it.
So it is not in presentation mode, sir. Full slide,
It's not
full screen, sir.
presentation.
Full screen, sir.
Can you see me changing the slide?
No, sir.
No, it's still stuck on the first slide. Okay, let me try and share it again. Give me 1 minute. Is this better now? Can you see it?
Yeah, now we are able to see, sir. Thank you, sir.
And can you see me also changing the slides?
Yeah.
Are the slides changing?
Yeah, change. Yes, sir. Yes, sir.
All right, great. Thanks so much. And thank you also for setting the stage wonderfully. Indeed, the financial sector in India has undergone major transformations over the last decade or so and has been contributing significantly to the overall growth and development of the country. And in fact, that is the financial sector's role, isn't it? In terms of intermediating, in terms of making sure that domestic savings and international capital comes in and is intermediated effectively for the growth and development of the country by allocating credit and equity to productive sectors of the economy, and that's something that's very important, and that's something the Indian financial sector has been doing well over the last decade or so. So during the course of my presentation, these are the issues that I'm going to talk about. I'm going to quickly take you through a very quick snapshot of the entire financial sector, how we see it, what's the outlook, what's been happening. Talk about a few recent developments. I have a few interesting charts that you might find interesting. And after that, and that's pretty much the first half of my presentation. After that, I wanted to dive in a bit deeper on a few sectors within the financial sector, which I felt were very significant given the emerging challenges and opportunities. And those are climate finance, digital public infrastructure, capital markets, and MSME access to finance. So without further ado, let me now move to and giving you an overall snapshot of how we see the financial sector as a whole. In terms of financial system development, what we see essentially is that both credit markets and deposit markets in India are fairly well developed. The growth in bank credit and deposits has been in line with GDP. If you look at private credit to GDP ratio for India, we are at about 51, 52%, and we've been there for about the last decade or so, which is a bit lower than our peers, and I'll come back to that later. But if you look at deposits to GDP, in fact, India has the highest deposits to GDP ratio, bank deposits to GDP ratio amongst all BRICS countries. So that's the sort of opportunity, but also the challenge. The opportunity that there is, we have a very deep deposit base. The challenge and the opportunity is then to intermediate it and convert it into productive credit for the economy. You might have heard in the news recently that now, over the last year or so, there has been sort of a competition for deposits amongst banks as other asset classes have emerged. But still, India still remains one of the economies which has a very deep pool of deposits. On the other hand, you have the equity market, which has been booming over the last 5 to 6 years. I'm sure all of you would have heard that India now is the fourth largest equity market in the world. So if you look at our major exchanges, BSE and NSE, we are now combined together, their market capitalization combined together is the fourth largest in the world. We've seen very large IPOs in the last 5 years or so. And what has been a structural shift or a structural transformation in the Indian markets is the increase in retail participation in equity markets. Now that comes with both opportunities and risks. We've seen that the number of individual mutual fund investors has grown manifold. As a result, the assets under management for the mutual industry have gone beyond 50 trillion or 50 lakh crore. now from about 25 lakh crores just about 4 years ago. So in fact, mutual fund industry has doubled in the last 4 years, 5 years. And that is great news for a nation of savers who used to always depend on fixed deposits. There is now more diversification as far as financial savings is concerned. However, this boom in equity markets also comes with certain risks. And these risks we see manifesting in certain segments, most notably the derivative segments. I'm sure all of you have seen the news where SEBI and the government have been cautioning about over-exuberance and over-exuberant retail participation in equity markets and particularly derivative markets, futures and options by retail investors. And in fact, data from SEBI shows that 9 out of 10 investors who participate or retail investors who participate in futures and options actually end up losing money. So there is a need to look at this opportunity again from a productivity perspective as to how you can ensure that this enhanced retail participation in equity markets is channeled through to productivity and not merely speculation. So that's again a challenge and an opportunity. On the flip side, when you look at capital markets, the flip side is our bond markets. And I'll talk about it a lot more during the later part of my presentation, but suffice it to say that they are nowhere as deep as our equity markets, much smaller in comparison to equity markets, and much smaller in comparison to our peers. Many of our peer countries, both within BRICS and outside, have much more developed corporate bond markets. Our bond markets are fairly shallow. Most of the issuers are either AA or AAA, which means that lower rated issuers don't really get access to markets. And most of the issuers, in fact, if you look at issuances in Indian corporate bond markets, half of the issuances come actually from financial institutions, which means that non-financial private issuances of corporate bonds in India is still pretty low. Moving to another very important aspect of the Indian financial sector, which is access to finance. And this is something that was stressed in the opening remarks as well. Ultimately, one of the goals of having a well-developed financial system is ensuring access to finance to the last mile. And India has done a fantastic job of this over the last 5 years. I'm sure all of you are aware of the flagship PMJDY scheme, which over the last 7 years or so has led to the opening of more than 500 million low-cost bank accounts all across India and has really helped connect people to financial services. What the PMJDY scheme has done has that it's layered one financial service on top of the other. Having a PMJDY account unlocked debit cards for these account holders. It also unlocked or also enabled enrollment into other very important government schemes, including the low-cost insurance schemes, which is the PMSBY and the PMJJY, and also for workers in the informal sector, enrollment in the APY, the Atal Pension Yojana, which gives informal sector workers a fixed amount of pension. So what the strategy essentially has done is it's used the digital ID, mobile, and PMJDY Trinity to unlock a whole suite of financial services for the unbanked and the underbanked, leading to a situation today where almost 80% of all Indian adults have a bank account. There is a large population among India which use digital payments. That's the good news. However, there are still challenges when it comes to financial inclusion in India. First and foremost is the gender gap. If you look at account ownership, there isn't much of a gender gap. Both men and women own bank accounts in the same proportion. However, the difference emerges when you look at account utilization. The World Bank does a financial inclusion report and survey every few years called Findex. And when you look at the India data for the World Bank Findex, what you essentially find is that there is a 13-point gap, basically 13 percentage point gap in account utilization between men and women, and a similar gap when it comes to actual utilization of digital transactions. So in essence, what I'm essentially saying is that India has done a tremendous job in ensuring access to financial services. The next challenge is to ensure utilization of financial services, and that's apparent from the fact that less than half of account holders today are using digital payments. I mean, India's UPI is a flagship product, which is rightly so heralded as an example for the entire world. But fact remains that when it comes to the entire Indian population, it's still only about half of account holders who are using digital payments. And similarly, if you look at the MSME sector, which I will talk about later, the credit to MSME sector still remains constrained. So the challenge here is how do you use this digital innovation to enhance and strengthen credit for MSMEs? Moving on to the macro financial environment, that's a bright spot for the Indian economy. There is a robust macro financial environment, stable interest rates, stable inflation. There is a high potential growth, and very importantly, we have a large and young population. As I'm sure most of you know, more than half of the country is less than 35 years old. There is a growing per capita income, and these are all positive factors, which are, of course, threatened somewhat from mostly external risks emerging from geopolitical scenarios, from interest rate scenarios in emerging markets, and so on and so forth. Uh, what is equally welcome and equally encouraging is the progress India has made on financial stability. If you look at banking and corporate and NBFC balance sheets from, say, 2014 to now, you will see a remarkable transformation of how things have happened. As I'm sure some of you would be aware, the RBI conducted what is called the AQR, or Asset Quality Review, in 2015, and following that, NPLs were finally recognized and shot up to double-digit levels. What that led to also was that a lot of banks, majorly public sector banks, being placed under something called the Prompt Corrective Action Framework, which prohibited lending and also needed them to take corrective measures. What we've seen over the last 5 to 7 years is a concerted effort from the government, from the RBI, and other stakeholders to manage the NPA and stressed assets situation in India. And that's been done through in a few ways. One is, of course, the introduction of the Insolvency and Bankruptcy Code in 2016, which has made it easier and faster to resolve NPAs and has led to a significant increase in recovery amounts or recovery rates. I mean, recovery rates are still in about 35-36%, which is not that high, but it's still much better than what used to happen under previous frameworks, under Sarfazi and other frameworks. The introduction of the IBC was one, but also we've seen tightening up of prudential guidelines from the RBI, which makes resolution easier and also more important to do for banks. We have regulations which sort of take care of the evergreening issues. It's much more difficult to evergreen loans now, so there is an imperative for banks to recognize stress when it actually happens on their balance sheets. We have seen a cleanup and recapitalization of public sector banks. Between 2017 and 2022, the government of India put in more than 2 trillion or 2 lakh crore rupees as capital into public sector banks, which has now led to them being in a much healthier position. And in addition to the recapitalization, we also saw consolidation. We used to have 27 public sector banks in India, which have now been merged, and we're left with 12. And there is, of course, discussion on further consolidation. And in addition to that, the government also came up with something called the ease reforms for public sector banks, which came out with a scorecard and an index for operational and efficiency reforms for public sector banks. So in a nutshell, over the last 7 years or so, what we've seen is that there is a well-coordinated effort at multiple levels to bring down NPA levels, and we see the result of that. We see that NPAs in India are now at a decadal low, and that will also be reflected in some of the charts that I have later in the presentation. As a result, public sector banks are in a much better position than they were maybe even 5 to 7 years ago, but still remain less profitable and have higher NPAs as compared to private sector banks. There are some structural issues which still need to be improved, and those are the challenges going forward. Bond market development is one where you still don't have a lot of retail participation. There's lack of depth in the market, and there is still a need to expand that. More than 50% of financial sector assets today, including banking, insurance, pension, and so on and so forth, are still within the public sector. Priority sector lending, a very important scheme, has been doing well, but perhaps there are certain challenges associated with that as well. So moving on very quickly from the banking sector to NBFIs. What has also been remarkable over the last decade is the emergence and the growing importance of the NBFI sector in India, and this includes insurance, pensions, NBFCs, mutual funds, and fintech. I was talking earlier about the AQR in 2015, and what we noticed was that once the AQR happened and banks sort of stopped lending or reduced their lending, it was the NBFCs which actually stepped in and filled in that credit gap. And you see for a period of about 2 to 3 years there, NBFC credit grew by as much as 20 and 30% year on year. And that went on, of course, till 2018 when we had the ILFS and the HFL crisis, which then sort of was an obstacle for further growth. But all in all, the share of NBFCs in financial sector assets has grown tremendously. Their interconnectedness with the banking sector has grown significantly. And as a result, NBFCs are now a much more important part of the financial sector than they were even 5 to 7 years ago. Similarly, insurance sector in India is fairly strong. We have very, very strong life insurers, particularly in the public sector, which is LIC, which is also the largest institutional investor in India. On the non-life side, of course, there are certain challenges. We have a few state-owned non-life insurers, which are not in the best financial condition. Some of them are insolvent, and of course, the government is trying to resolve them through various means. The pension sector has also been growing significantly, most notably through the contribution of the NPS. The NPS introduced in 2004 is now the fastest growing pension scheme in India, and because it's mandatory for all central government and many state government employees, has been growing in terms of assets under management for a very, very long time, and will continue to do so. So if you look at the EPFO and the NPS combined, those alone account for about 10% of our GDP. So the pension sector also, as a whole, has been growing significantly. Having said that, this has basically been good news. But what is also important is to look at some of the emerging risks in the financial sector. The first one, of course, is climate. As India is one of the most vulnerable countries as far as climate resilience, disasters, and the impacts of climate change are concerned, it's important to recognize the impact that climate change has on the financial sector in terms of both physical risks and transition risks. The Indian banking sector in particular is fairly heavily exposed to high carbon or carbon intensive sectors, whether that's automobile, energy, paper, cement, and so on and so forth. And changes in policy and also actual physical risks from climate change are going to impact profitability, are going to impact financial stability. So that's something that has to be accounted for going forward. There have, of course, been already initial steps taken by regulators to address these, but more needs to be done. Another one is, of course, digitalization, which has been a huge, huge benefit, but also comes with its share of risks in terms of cybersecurity issues, in terms of consumer protection issues, and so on and so forth. So that, in a nutshell, is what the financial sector looks like for India in a snapshot. What I'll now quickly do is take you through a few interesting charts that sort of map out the journey of the Indian financial sector over the last few years. If you look at this series of charts, what this essentially does is it compares the financial sector development in India with peer countries, mostly BRICS, but also other comparator countries such as Malaysia, Vietnam, Thailand, and so on, Philippines, Turkey, and so on and so forth. I draw your attention to the graph in the top left, which is the graph which shows you the Financial Development Index. This index is a publicly available index. It's put out by the IMF. What the Financial Development Index does is it takes 20 indicators across financial access, utilization, and depth, and relatively ranks countries on how well developed their financial sectors are or financial markets are. If you look at where India's position, and that's the red dot, what we notice is that India does very, very well amongst peer countries of the same per capita GDP level or per capita income level, which is why the red dot you see is pretty high. But if you compare India to other peer countries such as Brazil, Russia, South Africa, China, the other BRICS countries, we still see that we have a long way to go. And one of the reasons for that is the chart in the first row on the extreme right, which is bank credit to the private sector. That shows that India's, as something I was mentioning earlier as well, the bank credit to the private sector in terms of GDP in India has been stuck at about 51-52% for the very, very, very long time. And that's pretty low as compared to other peer countries. If you look at Brazil, if you look at China, of course, it's an outlier, but it's close to 200%. Even Brazil is close to the 100% mark. Same goes for Malaysia, Thailand, and others. India has been at about 50% for a very, very long time. And what that tells us is that financial intermediation needs to improve. As I was mentioning earlier, deposits to GDP, India is the highest amongst BRICS. But when it comes to bank credit, we lag. And that sort of means that there is a need to improve intermediation in the Indian markets. What is also notable is the chart on the bottom left to the extreme right, bottom row extreme left, on non-bank financial institutions. They have been growing in significance, but still, if you compare them to peers such as Brazil and South Africa, there is a way to go before Indian insurers, mutual funds, and pension funds grow to that same level of significance. The chart in the middle, something that I already talked about, adults with financial accounts. India has improved significantly. We are at almost at 80% now. But there is also, of course, the need to bridge that last mile, which means that there are still 20% of Indian adults, and 20% of Indian adults is a large number. It's close to about 250 million people who still don't have a bank account in India for various reasons, and there is a need to account for that. Moving now very quickly to what the structure of the Indian financial sector looks like and how it's been changing. Uh, if you compare the Indian financial sector structure between 2017 and now, we see some significant shifts. Most importantly, it's the share of commercial banks or scheduled commercial banks in total financial sector assets. In 2017, commercial banks used to hold close to about 60% of all financial sector assets. But when you look at the data for 2023 or 2024, you see that it's come down to about 48, 49, 50%. So there is a significant decrease in the share of scheduled commercial banks in total financial sector assets. What does that mean? It means that it's been distributed to other financial institutions, and significance of these financial institutions has in fact increased. Most notably, the share of NBFIs, which has gone up from 9% to 12%, but also pension and mutual funds, which have also gone up significantly. So, which means that there is going forward a need to look at NBFIs as a much more integral, as a much more important part of the financial sector. There is no doubt that India still remains a bank-dominated economy, but the role of NBFIs is growing. Similarly, if you look at within banks, the share of different kinds of banks by ownership, about in 2017, public sector banks used to account for about 68% of all total banking sector scheduled commercial bank assets. That share has now come down to 59%. And the reasons for these are multifold. Some of them I talked about earlier, where some of the public sector banks had to be put under the BCA, slowed down lending, had bad performances, high NPLs, low profitability, low return on equity, and so on and so forth. And that gap was then sort of filled in by private sector banks to a certain extent. Today, public sector banks account for about 60% of banking sector assets, but the share of private sector banks is growing and growing more rapidly than that for public sector banks. If you look at bank balance sheet composition, it's very typical of what we see in other emerging markets as well. Most of banking sector assets are funded by deposits. And as I mentioned earlier as well, the size of the banking sector relative to the entire financial sector is shrinking, whereas the size of the NBFI sector is growing much faster. And that's reflected in the middle graph on the bottom row, where you see that the size of the insurance, NBFC, and mutual fund sectors is growing much faster than that for banks. Moving very quickly now to monetary and financial market developments, policy rates, which are of course a key determinant of financial sector behavior, we saw that they fell to historic lows before the pandemic, and after the pandemic were stable for a long time before in 2021 starting a steep increase. Over the last 2 years or so, we've seen policy rates in India being raised by about 250%, 250 basis points, sorry, and that has sort of led to interest rates going back to where they were pre-COVID. In terms of liquidity conditions, which is the chart on the top row in the middle, they're fairly neutral. There was tightening earlier, followed by a period of loose liquidity, and now we are in sort of neutral territory as far as liquidity is concerned. Similarly, exchange rate volatility has been well managed. So you don't see, even though there has been some depreciation over the last 2 years, we still see that it's been managed well, and it's been ensured that there isn't much volatility as far as foreign exchange markets are concerned. Uh, what I'd like to draw your attention to in particular is the chart on the left, on the bottom row, the extreme left, which is on stock market indices, and that's where the Indian market has performed very, very well. Something that I was mentioning earlier about how now India is now the fourth largest equity market in the world, and we've seen a significant and consistent rise in equity markets over the last 5 years or so. In comparison, government bond yields and our benchmark 10-year yields have been range bound for a long time. Even currently, they're 7% or sub 7. They went up significantly a couple of years ago, and then have come down since. So, but government borrowing costs have been pretty stable for the last year or so and have hovered around the 6.97, 7.1 mark. Moving now to the financial sector's role in credit growth, and as I was mentioning earlier, that's one of the most fundamental aspects and fundamental functions of the financial sector to effectively intermediate credit growth for the economy at in a effective and also cost-effective manner. We see that total credit to the non-financial private sector, which is the chart on the top left, it's been pretty stable over the last decade or so, which means that bank credit to GDP has been at about 51-52% for a very, very long time. And what that results in is a large credit gap. So if you look at the chart, which starts from 2009, just after the global financial crisis to now, you see that the credit gap has always been negative, which means that there is a large credit gap or a credit need in India, which is going unmet. We see also that in the chart, in the first row in the middle, if you look at the credit going to various sectors of the economy, credit to the government accounts for about 50% of total credit. Household credit has also been going up, but private non-financial credit has, if you look at the average over the last decade or so, remained pretty constant and consistent. The chart on the right, extreme right in the first row, is very important and something that the regulator has also been cautioning about for a while now, and that's the rise, and the red part of the chart shows you the rise in unsecured personal loans. The tremendous growth in bank credit over the last 2.5 years or so has mostly been driven by retail and personal loan growth. And a large part of that is unsecured, including credit cards. And that's something which is good for top line growth in terms of bank credit, but is also worrisome from a financial stability perspective. We already saw in November 2023 the RBI cautioning against over exuberant lending to unsecured personal consumers. And we saw that they, in fact, increased risk weights for such lending from 100 to 125 to try and curtail that. And we see that now that has been working over the last 6 months or so. But still, there have been certain concerns over the growing share of personal and retail lending in the Indian financial sector and the risks associated with it, because these loans, which are mostly unsecured, if there is stress in the economy or if there is stress in the portfolio, they would essentially become very difficult to recover because they are uncollateralized and may lead to stress and losses for lenders. We see, of course, that bank lending rates have been growing for the last couple of years, and this is broadly in line with the increase in policy rates. As policy rates have gone up, bank lending rates have also gone up, and there is, of course, some concern that might stymie or that might inhibit the new capex cycle, but we might see that rates might come down now once the easing cycle starts, maybe over the next 6 months or so. What is encouraging to see, of course, is the chart in the middle in the bottom row, which talks about interest coverage ratio. And what that essentially shows us is that corporate balance sheets have been improving. They've been much healthier. And that is good news as we hope to start a new productive capex cycle. Moving very quickly now to financial stability and how India fares against other BRICS countries and other comparator countries. Indian banks are now very, very well capitalized. Average CRAR is much higher than the regulatory minimum, both for banks and for NBFCs. and we banks have comfortable buffers when it comes to capital adequacy. NPAs, something that I was mentioning earlier, have come down significantly. The latest data from RBI shows that gross NPLs for the banking sector are close to about 3%, which is the lowest they've been for more than a decade. So that is indeed encouraging news. Banks are also now more profitable, have better return on assets than they did about a few years ago, and also have much more comfortable liquidity positions as compared to peers. What that means practically is that banks, having taken care of legacy NPA issues, having cleaned up their balance sheets, are perhaps now well positioned to support growth in the economy in the next credit cycle, in the next investment cycle, which we hope will start. We also see this playing out in this series of charts. We see that both public sector and private sector banks have decreased their NPLs. Of course, in comparison, private sector banks have lower NPLs as compared to public sector banks, which has always been the case, and also have better return on assets and return on equity. One interesting thing to note about the Indian financial sector is the share of securities or government securities in total assets, and that's reflected in the middle chart on the bottom row, and that is sort of attributed to SLR and other requirements. As I'm sure you're aware, the RBI regulations mandate that 18% of all banking sector liabilities have to be invested in SLR eligible securities, which are largely central government securities. That, of course, creates a good captive market for Government of India securities, but also perhaps has an impact on credit creation and on the multiplier effect that the banking system has. Perhaps the last in my series of charts, and this is interesting on NBFIs, something that I was mentioning earlier on the growing role of NBFCs in the Indian economy. We see that the share of NBFCs in total assets has grown. It's grown from about 9% of total financial sector assets to over 12%. And that also leads us to the conclusion that regulating and supervising them more effectively is ever more important. We saw in 2022, the RBI came out with a new scale-based regulatory framework for RBIs, for NBFCs, which places a heavy emphasis on the top or the upper layer and the top layer of NBFCs. So the largest NBFCs are regulated more stringently as compared to the base layer NBFCs. And what we see is that that has resulted in consolidation in the NBFC sector, which means that stronger corporate parent bank NBFCs have done well compared to standalone NBFCs. And NBFC NPAs have also come down. Since 2018, since the ILFS episode, we've seen a consolidation in the NBFC sector. The NPAs have come down. Their funding the funding pattern has shifted. And what is now happening, and perhaps again a cause for concern for the regulators, is the increasing interconnectedness between the bank and NBFC sectors. Bank loans outstanding to NBFCs have more than doubled in the last 5 years. And the RBI again took note of that in November 2023, when they in fact increased the risk weights for bank lending to NBFCs in most cases from 100 to 125, and that's sort of led to a slowdown in bank lending to NBFCs. But the fact remains that the bank and NBFC sectors are now much more closely interconnected than they used to be, and that means again that much closer supervision and regulation of this sector is required. I will now conclude this part of my presentation. The idea was here to give you, through these series of charts, an idea of the evolution of how credit markets and overall stability in India has sort of evolved over the last 7 years or so. In the remaining 10 to 15 minutes I have, what I want to do very quickly is move on to 4 different sub-segments of the financial sector, which I feel are important and which we've seen a lot of developments in, and which will have both opportunities and challenges going forward. First and foremost of these is climate-related risks in the financial sector. As I mentioned, Indian financial sector is exposed to both transition and physical risks. In the Indian financial sector is exposed significantly to energy, as a sector and other high carbon intensive sectors, and hence is exposed to transition risks. On the other hand, the Indian financial sector is also significantly exposed to agriculture and other sectors, which are very susceptible to physical risks. And as such, the impact of climate risks on the financial sector will be both sector and location specific. If you look at the chart or the graph of the Indian map on the bottom right, the what it essentially depicts is the wheat yield change scenario under various climate change scenarios, and you see that big part of red all across the southern and eastern part of India. So essentially, if there are large losses in the agriculture sector in the real economy due to climate change, that will definitely have an impact on bank balance sheets, on bank NPAs, as well as the overall stability of the financial sector. How these risks will materialize will, of course, depend on adaptation, government programs to manage them, fiscal incentives, and overall insurance coverage. But what is, of course, important is the need for much more granular and detailed data coverage as far as geographical and sector-specific information on these risks is concerned. Along with risks, of course, there is going to be a large need for increasing climate finance in India. As you all know, India has ambitious climate targets. India hopes to achieve net zero by 2070 and also has significant NDCs that we've announced for 2030. What that leads to and translates to is a need for large climate finance investments. There are estimates which show that the climate finance gap in India is as large as $150 billion annually today. And that means that all segments of the financial sector, whether that's banks, DFIs, the bond market, all of them have to step up and increase the financing for climate action. We see some developments on this in recent years. The banking sector has been increasing its green finance space. Primarily, it's been in the renewable energy and the EV market. However, there is a need for broader inclusion of greener activities in the banking sector, and some of it, as banks have been demanding, could probably be done through the PSL or the priority sector framework. But the fact remains that most of green financing today is done for renewable energy and for EVs. But the worrying fact today that we see is less than 2% of total bank credit even today goes to renewable energy, even though that is in fact some of those projects are included in the priority sector list. There are, of course, there have been few initiatives to improve green finance in India. On the banking side, we've seen the launch of the green deposit guidelines for the RBI, but in the market, we don't really see a pickup yet. And in parallel, on the bond market side, we've seen two important developments. First is, of course, the launch of India's sovereign green bonds. There have been 3 issuances since 2023, and that has in fact seen a good interest. We've seen them fully subscribed. And the first issuance of Indian sovereign green bonds, in fact, got a greenium or lower yield of about 6 basis points compared to a conventional sovereign bond. And that has helped fund public sector projects for climate action in India, including clean transportation, renewable energy, and others. However, the concern remains that there is still the domestic green finance market remains limited, whether that is on the banking sector side through green deposits and green loans, or on the bond side through issuance of domestic green bond markets. The interest of institutional investors is still limited. There is still we also see that the greenium for green bonds has in fact been coming down since the first issuance of the sovereign green bonds. And the overall domestic labeled bond market remains very underdeveloped. And what we see is that more than 90% of our of green bond issuances by Indian issuers, in fact, happen offshore. There is a need to onshore that activity. We see some developments because of the introduction of the IFSC or GIFT City, which I'm sure all of you would be aware of, and how many of the issuances are moving there. But still, most of the green bond market or the green bond issuances by Indian issuers remain concentrated in offshore issuers. There is also a need to better leverage the DFI ecosystem in India. As I'm sure all of you are aware, we have sector-specific DFIs in India, including SIDBI, NHB, NABARD, NABFID, and Exim Bank. and some of them have made efforts to improve their climate finance portfolios. Most notably, SIDBI, which has a climate finance portfolio of over $1 billion today. But still, there is a need for them to start playing a more active role in channeling finance for climate action, not only through their direct financing activities, but also maybe through de-risking, through other innovative financial instruments such as blended finance, which actually can help them leverage the impact of their limited fiscal resources. I know I'm running out of time, so I will move a bit quickly. Just to reiterate a few of my points on climate finance before I move on to other segments. There are key barriers which are inhibiting the growth of green finance markets in India. The first and foremost is a lack of a commonly agreed taxonomy. The good news is that the Indian government, as part of the Union Budget in July 2024, announced that now the Indian government will be coming out with a unified climate finance taxonomy, and that should be a big boost for climate finance markets in India. There is limited awareness and short-term horizon as far as institutional investors are concerned. There is a general lack of expertise in the financial sector, and also lack of general liquidity when it comes to these green financial instruments. There is a lack of adequate and scalable risk sharing, guarantee, de-risking mechanisms to crowd in the private sector for climate finance. And there are sector-specific challenges, which I will not talk about in the interest of time. Switching gears now very quickly to an area where India is a shining example for the rest of the world, and that's on digital public infrastructure. I won't spend much time on it because this is an area that we've been doing very well on. All of us are aware of, in fact, I'm sure most of us use the flagship DPI in India called UPI, the Unified Payments Interface. It's gone from strength to strength. Volumes have doubled in the last 2 to 3 years, and it's becoming increasingly convenient for a variety of use cases. There are of course some concerns over competition in the payments market, particularly in the UPI market. We see that 2 or 3 large players have a significant market share. So there is a need to increase competition and oversight, and perhaps also improve the governance structure of the DPI to improve system efficiency. One aspect that I will touch upon later also in detail is the digital lending market, which is growing rapidly, both for personal loans and also for retail loans. On the personal loan side, of course, that also comes with its own share of concerns, particularly on market conduct and consumer protection. We hear stories and incidents of unauthorized apps, digital lending apps, which have led to consumer protection issues for borrowers, which charge very high and usurious rates of interest, and also take over the phones of certain borrowers. So these are all concerns that we've been grappling with. One very promising piece of DPI, which is the account aggregator framework, we see working very well for retail clients, but in terms of efficiency gains and in terms of using account aggregator to push and to promote digital credit for both personal and MSME borrowers, the impact has been rather limited, and that needs to be done in that aspect. Very quickly now, moving on to capital markets before I talk about MSMEs. As is something I was mentioning earlier, the bond market remains stagnant and small, only about 16% of GDP. Outstanding bonds to GDP is only about 16%, which is much lower as compared to peer countries such as Brazil, China, Russia. It's dominated by highly rated issuers. More than 85% of all issuances in the Indian corporate bond markets are rated either AA or AAA. The average tenure is much shorter, only about 3 to 5 years. And more than 97% of all issuances are in fact private placement, which means that public issuance of debt securities is in fact very low. SEBI over the last few years has taken a few concrete steps to deepen the market. This includes the introduction of the mandatory use of the electronic trading platform and the bond platform for private placements, but we still don't see its impact in deepening the market. There is also a new initiative for a repo of corporate bonds and also a backstop facility, which has been introduced to help out debt securities and bond markets in periods of stress. But the fact remains that for most institutional investors in India, including large insurance and pension funds, they remain restrictive in terms of their investment guidelines. Most institutional investors in India cannot invest in anything below AA, and that you then see reflected in the bond markets. If all large institutional investors in India are going to demand securities which are only AA or AAA rated, that's where you'll see the market to be headed. Uh, Unlike the equity market, which has a high retail participation, the bond market we see does not reflect that. Most of the participation in the bond market is from institutional investors. The participation of retail investors, both in corporate bond markets and government bond markets, remains very, very low. We've seen developments in the last few years, including the launch of the RBI Direct platform and a few platforms on the corporate bond side, which make this retail participation easy, but still hasn't shown the sort of growth on the corporate bond side. Mutual funds, as I mentioned earlier, have been growing tremendously. AUM our assets under management has doubled over the last 5 years or so, but still remains smaller as compared to peer countries. 60% of the investor base is concentrated in retail sector, which is a promising sign, and institutional investors participation is low, including maybe except for the exception of the EPF, because most institutional investors, including insurance companies and the NPS, they prefer to invest directly rather than mutual funds to keep management fees lower. A side effect or a fallout of the capital markets is, of course, an infrastructure finance. We see that there is a big infrastructure finance gap in India, of somewhere between 4 to 5% of GDP. And most importantly, greenfield financing remains a large challenge. We have very, very large state-owned NBFCs in the infra space, whether that's the PFC, the Power Finance Corporation, the REC, the Rural Electrification Corporation, and so on and so forth. But again, institutional investors, such as insurance and pension funds, we see limited participation in the infra finance space. And similarly, there is a lack of foreign investors as far as infra financing is concerned. So in a nutshell, capital markets in India have been developing on the equity side, particularly through mutual funds, but bond markets in India, especially in a scenario where we see that deposit growth seems to be slowing down, bond markets are also struggling. And so there is, on the debt side, a need for a way to sort of enhance participation and growth of this segment in India. I'll just take quickly 5 more minutes to take you through some very, very interesting charts and data on MSME access to finance. MSMEs, as I'm sure all of you are aware, is perhaps the engine for growth in India. MSMEs account for about 30% of total GDP and more than 40% of total exports in India. There are close to 70 million registered MSMEs in India, as per the Ministry of MSME data. And the MSME sector is also the second largest employer in India after agriculture. They have anywhere between 120 to 130 million workers who are employed in various MSMEs. And that's why improving access to credit for MSMEs at reasonable rates is something which is vitally important for the growth in the Indian economy. If you look at the chart on the top left, the evolution of MSME bank credit, you see that it's grown. And specifically, it's grown after, you see a significant growth after COVID. So July 2020 to July 2022, there was significant growth. And this growth is, of course, also supported by a group of government schemes which were launched in the wake of COVID, most notably the ECLGS scheme, which provided 20% top-up or additional credit to MSMEs, which was then fully guaranteed by a government-owned guarantee fund. So if you look at the evolution of MSME bank loans, it's been growing over the last 5 years or so, but still there is a need for much more, because even today, if you look at the data, the addressable MSME credit gap, which means that the demand for credit from MSMEs, which is being unmet today, is anywhere between 11 to 16% of GDP. Even the RBI Expert Committee report on MSMEs in 2019 highlighted the fact that the addressable MSME credit gap in India was anywhere between 20 to 25 trillion or 20 to 25 lakh crore rupees. So that's something that needs to be addressed. On the financial institution side, you see that public sector banks account for about 43% of credit to MSMEs, whereas private sector banks are about 42%, 43%. So the share of public sector and private sector banks is pretty similar now. About 44% of all bank loans are going to micro enterprises. And of course, we know that there are many schemes by the government which support loans to micro enterprises. Significantly, the largest scheme among those is, of course, the PMMY or the Mudra loans. Every year, we see about 4 to 5 lakh crore being disbursed under these Mudra loans, which accounts for this large share for micro enterprises. Also, what is also significant to note, of course, is that 2021, the definition of MSMEs itself was changed. We moved to a composite definition comprising of both investment in plant and machinery and also turnover, which means that the universe of MSMEs is now expanded. As per data from the GST network, more than 99% of all firms registered on the GST network are now categorized as MSMEs, which means the universe of MSMEs itself has expanded, and so their credit demands have grown as well. If you look at the last chart on the bottom right, we see that if you compare MSME loans outstanding to total bank loans between India and other countries, we again see that some of the peer countries such as China, Turkey, and Indonesia, in fact, have much higher loans to MSMEs as a share of total bank credit as compared to India. India today is somewhere around the 15% mark, and perhaps there is definitely a need for us to improve that. Given that, of course, the MSME sector has a large impact on both growth and employment in India. This slide essentially captures what I just talked about earlier. Total MSME credit has been growing. It's been growing a bit faster than overall non-food credit. Overall non-food credit is about 12% over the last 2 to 3 years, whereas MSME credit was about 14%. Private sector bank credit has been growing much faster. The fastest growth we've seen is in NBFCs. There have been a few government policies which have been supporting this. The expanded definition of MSMEs that I already talked about. Also, the inclusion of trading MSMEs in addition to manufacturing and service MSMEs in priority sector lending. One of the most important developments has, of course, been RBI's new co-lending framework, which came about in 2022, which allows banks and NBFCs to co-lend to MSMEs, which are, of course, included in the priority sector lending scheme. And we've seen that pick up quite a bit. The emergency credit lines during COVID also helped maintain the flow of credit to MSMEs and ensured that their overall health and employment potential remained, and their ability to retain employment remained secure. And of course, the new Udyam portal for MSMEs also makes it easier for them to access credit and other services. If you look at NPA trends for MSMEs, they are higher than overall NPLs, but perhaps that is to be expected, particularly in the NBFC segment. My last slide before I stop is on digital lending, because and I actually put it in because I felt that this was something important. The next sort of revolution, the next large or major development in the MSME lending space will perhaps come from digital lending. We see that it's only about 1.5% of total MSME credit now. Most of the digital lending in India is right now focused on the retail lending side, but there is significant potential to scale up digital lending to MSMEs using the increased amount of data that you have now. One example of this is something called the FIT score, which has been introduced by SIDBI, which only uses 3 very simple data points, which that being the bank account statements of the MSME, the GST data, and the personal tax data of the proprietor or the owner to generate a credit score. And what that does is that addresses a huge pain point when it comes to MSME lending, and that is the lack of information and the lack of collateral. Many MSMEs do not have sufficient information. They have low degree of formality. Their bookkeeping is not as advanced, and also most of them do not have the level of collateral that many banks look for when it comes to lending to them. So digital lending addresses both of these needs by making sure to leverage existing data, which is easily accessible, but also using this information and data as collateral instead of physical collateral to, in fact, lend to these MSMEs. Digitalization of MSMEs itself is lagging, so there is a need to grow that, including KYC and other other issues. And what is important also is to link banks to the Udyam portal through APIs. As I was mentioning earlier, there is an initial effort to use some of this data for credit guarantee and for credit appraisal, but that needs to be scaled up. FLDG or first out default guarantee have also emerged as a popular instrument, particularly in co-lending arrangements between banks and NBFCs. RBI, of course, has come up with more stringent guidelines on these, which has enforced market discipline. But the last point I want to emphasize essentially is that there are digital platforms which are doing MSME digital lending even today, and these include online PSP loans and even more significantly the Open or the OCEN or the Open Credit Enablement Network. But there is a need to promote more, and they have in fact the potential to promote end-to-end digital financing and cash flow-based lending for MSMEs, which has the potential to bridge the large financing gap that they have currently in India today. So that's on digital lending for MSMEs. In conclusion, and that's the end of my presentation. But in conclusion, all I would like to say is that in the Indian financial sector has made significant progress over the last 5 to 6 years. What it needs to now, looking forward, is becoming more fit for purpose and more efficient in addressing and servicing the financing needs of the economy. And this includes key sectors such as infrastructure, climate, and MSMEs, and do a better job of making credit available to these sectors at reasonable rates, while of course ensuring financial sector stability and resilience. That brings me to the end of my presentation today. I hope this has been useful, but let me stop here and happy to answer any questions or discuss further as needed. Thank you so much.
Saram sir, a very good morning to you, sir. Thank you for your presentation. So I have a question that you mentioned about the investment and capital cycle. Can you just please explain more on that, sir?
Sure. Thank you for your question. Essentially, so if you look at credit in India, what we see is that it usually follows certain cycles. So the last credit cycle we said, as some of you may be aware, a credit cycle which started after 2004 was this big push by banks to lend for infrastructure. We had a big push, including by public sector banks, between say 2004 to 2014. There was a big credit cycle, and what credit cycle essentially means is an increase in credit by banks to a certain sector. So, for example, bank credit to infrastructure, in fact, went up significantly between 2004 and 2014. And what that, of course, then resulted in is a down cycle where we saw that a lot of these large projects and large loans, in fact, became NPAs because of project appraisal and other issues. So, but that's essentially what I mean by a credit cycle, where there is initially a boom, where you see between 2004 and 2014 a significant increase in credit to certain sectors, and then following the AQR or the asset quality review in 2015, then you see a significant downturn in credit to those sectors. So if I talk about again the infrastructure and corporate sector, we saw a significant rise in credit to these sectors from the banking sector between 2004 and 2014, and then from 2015 onwards we see a significant decline. And then now, given that banks and corporates have cleaned up their balance sheets, are in better health, we may again see an uptick or an increase in credit to some of these sectors. So that's essentially what we mean by credit cycles, of this alternating pattern between increase and decrease in funding to certain sectors.
Thank you, sir.
So, sir, as you said, like the future and option markets in India is very low, but if you compare the future and option markets in US, it's like very high. If you look, most of the billionaires, there are more traders, but whereas if you look at India, it's very low, like compared to them. Why do you think the difference is there much?
Sorry, I've lost connection. I'm not sure. Pardon me, I lost you there for about 10 seconds. Would you mind repeating the question, please?
Yes, sir. The future and markets, future and option markets in US is very higher as compared to in India. Why is there so much difference? Like, if you look at most of the billionaires, they are more on future and option markets. They go more based on that. Whereas if you look in India, it's very low. Why is that?
Sure. No, thanks for the question. So I think to answer that, we have to look at the evolution of Indian markets themselves. if you look at the Indian regulators, whether that's SEBI or RBI, the issue or their outlook has always been to first ensure investor protection. We have to be cognizant of the fact that India has traditionally not had very sophisticated investors at the retail level. So the regulators, in fact, have always cautioned and always tried to limit participation in futures and options. And the reason for that is that these instruments are very leveraged, right? If you've ever used futures and options, you know that they can be very highly leveraged. And with a very small initial margin, you can in fact take a very large exposure. And we've in fact seen that happening ever since COVID. In the last 4 years or so, in fact, even in Indian retail equity markets, we've seen the volume of futures and options more than double. I think it's gone up by, I think, 3 times or 4 times. And in fact, the regulators, in fact, cautioning against it now. If you listen to the SEBI chairman or other regulators, they've in fact, even the finance minister for that matter, they've in fact been cautioning against the rampant use of futures and options by retail investors. And the reason for that is most retail investors perhaps aren't sophisticated enough to understand the correct use of these futures and options. I mean, derivative products, as I'm sure you well know, can be used for hedging and can be used for speculation. Most corporate users use them for hedging, but it seems many more retail users in India now are using them for speculation, and that opens them up to large losses. So to answer your question, why it's been limited in India so far, I think it's been a push from the regulator to make sure that retail participation is limited because of the sophisticated nature of these products. But having said that, we see now that there is, in fact, a lot more retail participation in futures and options, to the point where, again, I was mentioning this during my presentation, that 9 out of 10 retail investors in India are, in fact, losing money on retail on futures and options. So perhaps there is a need for concern there. But the market for futures and options in India is growing on the retail side, and perhaps will continue to grow as we see more and more sophistication and more informed and learned investors on the retail sector on side as well.
Okay. So one more question, like which is a better investment opportunity? Like is it better to invest in normal banks, like deposits in banks, or deposit in government bonds? Like government bonds give us a normal dividend rate, normal, and whereas even if you invest in banks also it's same. But what is the impact if you go more into government bonds on banks, sir?
Thanks for your question. I think that's a difficult question to answer. I don't think I can give you investment advice. What I can tell you essentially is that it's important to sort of compare the features of various instruments, investment products. So if you look on the debt side, the two that you mentioned is bank deposits vis-a-vis government bonds. There are a few key differences there. Government bonds, the first thing is that you're exposed to market risk. Unless and until you hold government bonds to maturity, you're always exposed to market risk because the value of the government bond, as you well know, will change as per the yield. So if you're a retail investor in government bonds, you're exposed to market risk, which may not be the case as far as bank deposits are concerned. The second concern that you may have with government bonds is, of course, liquidity. You may have limited liquidity when it comes to exiting position in government bonds. There is a platform called the RBI Retail Direct Platform, which the RBI launched to allow retail participants to have direct participation in Government of India bonds and also have liquidity there. But if you look at the risk return portfolio, very similar. It's just about your investment preference and your horizon. If you're fairly sure that you want to hold the instrument to maturity, perhaps government bond could make sense for you if you're not that concerned about liquidity. On the other hand, if you want the flexibility of withdrawing your money at any point in time, perhaps bank deposits make more sense. Though, of course, even some bank deposits also have a penalty for premature withdrawal, but of course they offer more liquidity. So to answer your question in short, it's a preference between liquidity and security. Government bonds, perhaps less liquid for retail investors, but could offer slightly marginally higher returns, but are of course exposed to market risk. Bank deposits perhaps offer better liquidity, but you also have to understand the fact that bank deposits also carry some risk. I mean, we don't think about it that way, but deposit insurance for banks is only about 5 lakhs in India. So any amount above 5 lakhs is not in fact covered under deposit insurance. So taking all these factors into consideration, the decision is yours, but these are the factors that you have to consider when you compare a bank deposit to a Government of India bond.
So one last question. if you look at the Indian economy now, like in the financial sector itself, fintech companies are growing now, sir, and even mutual funds are growing. Like if you look at the compensation of mutual funds, there's an asset management, like there are various levels to implement before starting up a mutual fund. You need a asset management companies and all that under you. But whereas if you look at fintech companies, they won't require much. So will there be a growth of fintech companies in the future as compared to mutual funds?
Okay, no, that's a good question. But what we have to realize is that the function of these fintech companies and mutual funds is fundamentally different. Let's take the example of, let's say, Upstocks or Grow or any of these new fintech apps that you see. They are not fund managers. Essentially, they are brokers or intermediaries to mutual funds. So essentially, what an Upstocks or a Grow or any of these fintech apps on the investment side are doing are they are facilitating investment. They don't manage investments. Mutual fund, on the other hand, in fact, actively manages investments. They are taking your money and making investments on your behalf. And that's why the regulations for mutual funds are much more stringent. In general, if you look at fintech companies, if you look at them as a facilitator, regulations for them will be much more lenient or much more relaxed. But the moment any of these fintechs actually take on balance sheet exposure, so if you look at any NBFC fintech on the credit side, so whether that's Credit B or online, all these online loan platforms, the moment they become a on balance sheet lender, which means that they are taking credit risk, they are subjected to the same regulation as a regular NBFC. Similarly, on the mutual fund side, the moment you have a fintech which becomes an asset manager and not just a broker or a facilitator, they will in fact be subject to the same regulation. Having said that, the growth of these fintechs has been based on the fact that they are much better at providing an interface and facilitating this growth in ease of investment into all these products. So essentially, these are two different business models between a facilitator and an on-balance sheet or an actual asset manager. The moment you have on-balance sheet exposure or actively managed assets, they will be subject to the exact same regulation. And so the growth will then be dependent on the level of innovation and the kind of products that you're able to offer to your consumers.
Thank you, sir.
Sir, I have another question. So just before some time you said that the participation in bond market is very low. So first question is why is it that in India the participation is low apart from the liquidity issue? Because of low participation there is not much liquidity in the bond market. But apart from that, why do you think is the participation so low? And if a regular sovereign bond itself is not so attractive, why should we prefer a green sovereign bond?
Sure, no, thanks. So when it comes to retail participation in corporate bond markets, some of the reasons are very historical because India, as you know, has been a bank-dominated economy, and so that's an instrument that is much better understood as far as financial instruments go. So that's one reason. Just familiarity with banks more than corporate bond markets. The second is ease of access. If you wanted to book a bank deposit today, you can do it very easily. If you want to buy a corporate bond, you either have to have a brokerage account with a brokerage house, or you have to use one of these new apps, whether that's Upstocks or Grow or so on and so forth. So familiarity along with ease of access is why there's been lower participation. Also, it's just lower knowledge of corporate bonds as an asset class, and also the comparison. So typically what a retail investor would look at is historically in India, level of financial savings that a retail investor could do has been on the lower side. So if I'm going to save, let's say, 1 lakh rupees a year, for example, my calculation is which instrument do I want to look at? Do I want to look at a bank deposit? Do I want to look at, say, a PPF, Public Provident Fund, which gives me 7% and is tax-free? Or should I look at corporate bonds, which give me maybe 7.5% or 8% for a AAA rated corporate bond, but is not tax-free? So it's a combination of factors why we have lower retail participation. One is familiarity and historical reasons that I mentioned. The second is ease of access. And the third is, given the limited amount of financial savings, the comparison between products and then choosing what makes sense for you from a from a return perspective, but also from a tax perspective. Coming to your second question on sovereign green bonds, I agree that a retail investor who does not buy a sovereign bond perhaps will not buy a sovereign green bond. The only factor there is, of course, your personal preference or your consciousness towards climate action. There is of course a class of investors, even the retail side, who are willing to accept a slightly lower return on a sovereign green bond with the intention that that money then gets used for climate action, for greening of the Indian economy, and for broader climate goals. So, in fact, even internationally, we see there is a whole class of what we call ESG investors who are willing to invest in companies and in products which offer perhaps a slightly lower return because they see a social benefit or a social value in investing something that is climate oriented or ESG focused or ESG climate and ESG focused. So that's essentially why. In India, perhaps that market would be small. I agree with you. In fact, what I was mentioning earlier was that green deposits as a product has been launched in India, but we don't see a lot of uptake just yet. And that's perhaps one of the reasons. But yeah, I agree. There is the uptake on the retail side could be low. But some of the reasons, as I said, is a class of investors or a segment of investors who are more conscious and more willing to accept a slightly lower return in order to promote climate action in the country.
So another last question. So as we know that there is a rise of gig economy in the overall world per se, because US already there has been a large number of gig economy, and India also is developing. So how will the introduction of the gig economy impact the financial sector? Like how should our financial system gear up for introducing the gig economy?
No, that's a very, very interesting question. So essentially, when you look at gig economy, what that essentially does is sort of transform your traditional understanding of employment as a secure, stable employment, which is a 9 to 5, and you spend a long time in the company, and then you have a very stable, predictable income. Now, what does that mean for the financial sector? Primarily, what it means is that your method and your approach to, say, credit appraisal has to change. So whenever you as a salaried employee approach a financial sector or financial institution for a loan, what they look at is your employment history, your cash flows in terms of your salary, and how predictable they are. Given that the gig economy by its very nature is unpredictable, you may make 50,000 in 1 month, 2 lakhs in the next month, and maybe 1 lakh in the third month. It's unpredictable. It could be seasonal, and you could work for multiple employers at the same time. You could be a freelancer. Let's say you're a freelance coder who works for 5 different companies writing code at the same time. So what financial sector needs to do is come up with more innovative ways of evaluating such a consumer. Can I take all these different pieces of information, the various gigs that you're doing, the various payment sources that you have, your irregular working hours, and still build a credit model which accurately predicts your ability and your capacity to repay? So that's going to be one challenge. So because more and more we're going to see borrowers who will not have this stable, predictable cash flow in terms of salary. That's one. And also in terms of the products that you offer for investment, perhaps something like an SIP or a systematic investment plan may not make sense for a gig worker because they don't know whether they're going to have a stable monthly cash flow. So can you then design investment products which take into account this variability and still service the investment needs of a typical gig worker? So basically, in a sense, what the financial sector will need to do is innovation in terms of products to account for the fact that gig workers are going to have unpredictable cash flows and will not have the stable kind of employment that they're used to as far as traditional borrowers were concerned.
Thank you very much, sir. I think for the lack of time, we will stop, though many students are interested to have queries, and I think probably I will consult and share it with you, and maybe some other time when we can have interaction. Thank you, sir. Thank you very much for joining us.
Thank you to all, and thank you for inviting me, and I wish the rest of the workshop success. Best wishes. Thank you so much.
Thank you, sir, for highlighting the various challenges and opportunities faced by the various facets of the Indian financial system. Sir used informative visuals highlighting various indicators and a comparative analysis with respect to BRICS and other emerging market economics. Overall, the sector has an optimistic outlook but suffers from several setbacks such as climate change and non-performing assets. We thank you, sir, for this enlightening session despite your schedule. Your talk has surely inspired students to ponder over the prevailing issues in the sector. We shall now break for a short tea break and meet at 11 a.m. I request all the students to head to the quadrangle for the photo session. Academic career, having secured gold medals both for undergraduate and postgraduate studies. He joined the faculty of the Department of Commerce, currently the Department of Management and Commerce in 1987. He has over a quarter century association with the university, and he has donned several roles such as the Prasanthi Nilayam campus warden, director of the Brindavan campus, member of the academic council and the Brindavan Bhakti Sahayak Sangh management committee, member invitee of the Brindavan management committee. He also coordinated the syllabus technical review committee, contributed to the internal quality assurance cell, and was the nodal officer for the National Academic Depository and also control of examination for the Sri Sathya Sai Institute of Higher Learning. He was associated with the university's awareness course based on human values, a unique facet of the integral education at Sri Sathya Sai Institute of Higher Learning, both as a faculty and as a syllabus committee member. He was also research personnel for the number of conferences based on values. Sir has also delivered a number of public talks, both India and abroad, notably in countries such as Indonesia, Singapore, Malaysia, Sultanate of Oman, UAE, and various European countries. Sir's noteworthy achievements include playing a pivotal role in gaining recognition from India's insurance regulator, IRDA, for the BCom Honours Curriculum in Insurance, equating it to the Fellowship of Insurance Institute of India in 2010. During his tenure as a director of Brindavan campus, Sri Sathya Sai Institute of Higher Learning achieved a NAC rating of A++ in 2003 and A in 2010. Additionally, he delivered an invited talk on the importance of value education and SSSIHL model highlights at the inaugural function of 40 workshop for school teachers on the integration of human values in teaching, organized by the Ministry of Education, Sultanate of Oman in Muscat on September 28, 2011. He is currently working as Associate Professor with the Department of Management and Commerce. So today we'll be speaking upon ethics in the world of finance.
offering my loving pranams at Bhagwan's lotus feet, esteemed Chancellor Shri Chakravarti Garu, Dr. Raghavendra Raju, Head of the Department of Economics, Mr. Rajashekhar, other distinguished invitees, faculty of the Department of Economics, students, and also all those who have joined us virtually for this workshop. At the very outset, I express my gratitude to Dr. Raghavendra Raju for this invite. My association with finance is decades long, and also with value education, but this is the first opportunity I'm getting in a public forum to share some of my reflections on ethics and the world of finance. So let me confess, this is a title which I have borrowed from a very important conference which took place in our university way back in 2010. It was the tenure of our then Vice Chancellor, Professor Vishwanath Pandit, and he was very particular that though I was in Vrindavan, I should come down to Parthi and be part of the proceedings, be part of the deliberations. So I also dedicate my reflections to Professor Pandit for that golden opportunity which he gave me. Let me begin with a small conversation I had during that conference. Of course, the deliberations were very fruitful, very meaningful, but one very precious memory I have is over a breakfast session. We were in Shanti Bhavan, and I was with two of very distinguished members of the conference. On the left of me was Mr. Aditya Puri. He was the managing director of HDFC Bank. And on the other side was the representative heading the IRDA regulation. See, one thing I would like to underline for our students, we did have a very wonderful presentation on finance this morning by Mr. Venkat. But the brief that has been given to me is to share my thoughts on finance with a human face. So that's how I happened to choose a topic of this nature. No matter how, what should I say, magical or very abstruse the world of finance may appear, but ultimately it is men and women who are executing the policies and the practices in any field, and for that matter, even the world of finance. Two persons I'd just like to mention, just to underline my thought. Just maybe 2-3 days ago, we got the news that our esteemed governor of the Reserve Bank of India, Mr. Shaktikant Das, has been nominated for the second time as the best central banker in the world by Global Finance magazine. So we're very proud of that achievement. We have always been proud of the Reserve Bank as an institution. It has done yeoman service for our country. It protected its policies and practices, protected India during the global financial crisis which hit the world in 2008. And leading from the front is Mr. Shaktikant Das today. I also like to mention the other regulator. You know, Mr. Venkat was talking that Indian stock market is the 4th largest equity market in the world today. Now, that's definitely something to be noted. But again, in the last few days, we just came across the latest Hindenburg report, and they have made some observations on the SEBI chairman and especially on conflict of interest. So that's something which will unfold in the next few days. I don't want to make any further statement on that, but how do we ensure that when we occupy significant positions of responsibility, we do not get into this kind of a jam where we are deemed to be having conflict of interest. Having said that, let me come back to my story. So I was talking to Mr. Aditya Puri, and he came up with this personal anecdote. He was heading Citibank Malaysia before he moved to India to literally start HDFC Bank. And as they would call it in the advertisements in the early days, would say, India's world-class bank. So when they moved to Bombay, his wife suggested to him, see, I know that you will be entitled to a company flat, but at one point of time you will retire and then we will have to move into our own premises, and at that time we may feel that our standard of living has fallen. So my suggestion is, whatever we can afford, let us buy our own flat and live in that house. And Mr. Aditya Puri accepted his wife's suggestion and purchased a flat. Few days later, sometime later, his little daughter comes to him and says, Daddy, are you some small banker? Now you're leading one of India's top private sector banks and your own daughter feels you're a very small banker. So he asks the daughter, he says, why do you feel so? And she says, Daddy, our house is so small. So that's called peer pressure, right? She has gone to her friend's house, she has seen how spacious it is, and she feels their house is too small. So Aditya Puri tells his daughter, you go ask mummy this question. And that little child goes to her mom, and the mom gives an explanation, and she comes back to tell her father, Dad, mom has explained to me and I am fully satisfied. So that was the first part of the conversation. Again, sometime later, this girl comes to her father and says, Daddy, I want to go to school in a Mercedes car. And this is what Aditya Puri tells his daughter. See, why finance starts first at the very personal level. If you cannot practice ethics at the personal level, you will not be able to practice at the institutional level. He said, see, look here, my dear, whatever you need in life, your dad will give you and provide for it. You want expensive things in life, grow up, earn your own money, and buy what you want. I was very enamored that here is a man leading one of India's top private sector banks, and at a personal level, he practiced so much of conservatism, so much of, what should I say, respect for money. If I don't need something, I will not spend money on it. And in that sense, if HDFC Bank became what it was, being globally recognized as one of the top institutions with consistency of profits over a very long period of time, a long credit should go to the people at the helm of affairs. The second story I want to share is with the other gentleman, the representative of IRDA. And I was telling him about our own story of insurance in our university. It was the turn of the new millennium, and we had this thought, what should we give to our students in the Department of Commerce for the BCom honors, a curriculum for the new millennium. And the insurance industry had just opened up, and we were looking at starting new specializations for our BCom Honors program. So there were our friends in the insurance field. There was this secretary of GIPSA. GIPSA was coordination organization of the public sector insurance companies. So I was having a conversation with him. He said, see, ours is a service industry. And we come into play to do service when people are in acute distress. Somebody has died in the family, or there has been an accident, somebody is having some, hospitalization, or, similar kinds of hazards, fire, earthquake, etc. So people are in distress, and it is at that point of time that we have to deliver our service. And it's very important in our industry to have good people. And you are a university which specializes in producing good people. So we are made for each other. Our appeal to you, please start insurance specialization in the institute. And somehow the appeal was very persuasive, and that's how we started off. And of course, we had no clue of where to begin. We started with the UGC model curriculum. And it is at that point, that we met a very distinguished professional. He happened to be the public relations officer of our super specialty hospital, Prasanthi. And he was the former chairman of General Insurance Corporation. He looked at our syllabus, he looked at our textbook, and he said, are you sure you want to teach this? And we said, sir, this is the UGC model syllabus. And then he put us on a trajectory which was something unstoppable. I think insurance is the most technical course I have taught in this university in my entire teaching career. And he designed the syllabus, he designed the study material with the help of his professional friends. And the net result was that after my conversation with this IRDA gentleman, this happened sometime in August 2009. It was January 2010. He suddenly sends me an email and, sir, you were talking about that insurance. Can you just share what was your syllabus? So I asked our Vice Chancellor, Professor Pandit, and he said, better you only send from your mail ID. This was Professor Pandit's recommendation. And so it went. In February, they held their board meeting, and lo and behold, comes this email from the IRDA, the regulator of India's insurance industry. The board has decided that your BCom Honors curriculum for insurance for the 2 semesters is equivalent to the Insurance Institute of India's highest qualification. And that was something startling, and it happened in the tenure of Professor Vishwanath Pandit. So when Dr. Raju was expressing in the morning, should we or should we not have this workshop, I said the best way to express our tribute to such a wonderful person and such a wonderful professor, an iconic professor of our university over the last so many 40 years of its existence, I think, is to conduct a workshop of this dimension in his honor. Now, let me come to my presentation outline. Meaning of, the tagline of our workshop is a quotation of Bhagwan. Money comes and goes, morality comes and grows. This was the message he gave also to the top honchos of the world of finance in the 2009 conference. So I thought I'll just spend a little time on what does he mean by, it's just not just a statement. You have to reflect on it. You have to go into the depths of it. So I thought I'll share something on that. Perspectives on money as per Indian thought. See, money is viewed differently in different parts of the world. What is India's perception of money? Bhagwan Baba's guidelines for dharma, ethics. These are 2 dimensions of finance. One is how we raise our funds, and second is how we utilize funds. And the last topic which I thought I will take up is one of the insights we get from Bhagwan's teachings is that he would take mundane examples of day-to-day life and he would, give us tremendous spiritual insights. So what insights from the spiritual angle he has given us from instances from the world of finance. So that is the last part that I'll touch upon, and if time is there, we'll have some question and answers. So money comes and grows, morality comes and grows. Now, if you ask people of economics, what is money? They say money is what money does. The functional definition of money. So what does money do? Money has value. The first function of money is it's a medium of exchange, right? When we earlier had barter economy, there were so many economic inefficiencies with that. And so when money was invented in human society, it eliminated those inefficiencies and brought in significant exchange efficiencies. So one thing about money is that its value lies only when it is traded. Please understand, its value is only when it gets exchanged. Supposing you have money and you don't pass it on. Some years ago when Chidambaram was our finance minister, he used to be exasperated with the bankers of our country. He said, please understand, you're raising deposits to lend money. The dharma of a banker is to lend. And there was a literal freeze in the banking industry. They were so reluctant to lend, and they used to invest so much in government securities at that point of time. The day you stop trading money, the day it stops flowing among people, it loses its value. For example, in the First World War, when in Germany people lost faith in their own currency, land became the medium of exchange. So money has value only when it flows, not when it is stagnant. Money also has a store of value. That's the next important function of money. And the more time elapses, money loses its value. And that is why you have to, why does it lose? And students of economics will understand that's because of inflation, right? So all the time the purchasing power of the currency is declining, and therefore to provide an incentive for people to part with their money, you have to give interest. So it loses value with time, and therefore that parting of money has to be compensated with interest. Money, however, cannot be carried with you to your next life. So this is another thing, no matter how much money you accumulate, and that is the example that Bhagwan would give us about, look at, Alexander, he set out in the world to conquer the world, but finally when he died, he said, with empty hands, let my body, my corpse be taken across the town, showing people that Alexander who set out to conquer the world went empty-handed. So money has its own value and you must recognize. Now, morality. What is morality? Peter Drucker, perhaps the most prolific writer on management in the 20th century, in his book Management Tasks, Responsibilities and Practices, says the best instance of professional ethics has been, or who is a professional, was articulated in the Hippocratic Oath. Now, Hippocratic Oath is oath which doctors take, when they join the medical profession. And this is what Peter Drucker said, there cannot be a better professional ethics than what doctors take when they are admitted into the profession. And what is that oath? He says, primum non nocere. What does it mean? It means knowingly I will not harm another person. And Swami would often refer to Ashtadasha Puraneshu Vyasasya Doshanam Tvayam. What is that? Paropkaraya Punyaya Papaya Parapidanam. And he would translate it, help ever, hurt never. So if you have an opportunity to help somebody, do help. If you cannot help somebody, at least don't hurt another person. So that is morality. And why did Swami say morality comes and grows. Just as money gets value only when it is exchanged, morality comes and grows. Every time you do a good act, you do a moral act, the next time you want to do it, it becomes easier for you. Sow a thought, reap an action. Sow an action, reap a tendency. Sow a tendency, you reap a habit. Sow a habit, you reap a character, and sow a character, you reap your destiny. So this is the power of doing good actions. Every time you do it, you are reinforcing what Indian culture it is called sanskara. You are cultivating the capacity to repeat it again and again. And that is why when morality comes into your life, it has the capacity to grow. It will not go. Now, we know in our culture, Purusharthas, and this is the comprehensiveness of Indian thought, that all these four, dharma, artha, kama and moksha, have been considered to be the goals of human existence. So it's not that we were otherworldly. You know, artha is a very important goal of life. And the view of artha is that it should be like a shoe. You know, if it is tight, just as the shoe is tight, it is highly problematic for the person who is wearing the shoe. If it is loose, that also is highly problematic. So there is a problem with the abundance of wealth. There is a problem with the shortage of wealth. So in our culture, prosperity was never looked down upon. So this is something, you know, dharma, righteous action, artha, wealth and power, kama, desire, moksha, the final emancipation. All these were considered to be the goals of human existence. Now Swami puts it in a little different light. He said, dharma and artha, these two goals should be seen together. That means you should earn wealth with the practice of dharma. Similarly, kama, yes, as you satisfy your desires for the world, you should cultivate the aspiration to finally get out of this. You know, when he used to say that I have only one desire, and that is to make each one of you desire less. I give you what you want so that you begin to want what I have come to give you. So this is how Swami would relate to the Purusharthas. Now this is a shloka, a very famous shloka from Manusmriti. What I am saying is these are these, you know, seminal thoughts of Indian culture. And I want to quote it in verbatim. Dharma eva hato hanti dharmo rakshati rakshitaha. Tasmad dharmo na hantavyo mano dharmo hato avadit. What does it mean? Those who destroy dharma shall be destroyed by dharma. Those who protect dharma, they will in turn be protected by dharma. Hence, dharma should not be disregarded lest it may kill you. So this is from a very important dharma shastra, Manu dharma shastra, Manusmriti. The great economist of ancient India was Kautilya, Chanakya, and this is another seminal sutra from his Arthashastra, which is dated 2nd century BCE. Sukhasya moolam dharmaha. Foundation. You want to be happy in life, the foundation of happiness is good deeds. Dharmasya moolam arthaha. Foundation of good deeds is wealth. When you have wealth, you have tremendous propensity to do good work. Arthasya moolam rajyam. The foundation of wealth is governance. So you may have wealth, but how do you get that wealth? The root of it is governance. When you have good governance and when countries are blessed with good governments, they will become prosperous. Rajasya moolam indriyanam vijayaha. Governance is best administered by those who are self-controlled. And this is a very important, because when I come to later parts of our discussion, please remember this, that if you are self-controlled, if you are able to keep the 6 inner enemies of man, kama, krodha, lobha, moha, mada, matsarya, in check, and you are the master of yourself, then alone you will be able to do good governance. This is Chanakya in his Arthashastra. Now there's a seminal discourse of Swami recorded and documented in Sathya Speaks, Volume 2, Chapter 44, in which he explains what is dharma. See, supposing you want to know what is right and what is wrong, especially you will have daily dilemmas in the world of finance. So how do you distinguish between one and the other? First of all, what is beneficial over a long term is the true beneficial virtue. That which benefits you only in the short term, but just like, Coca-Cola fizz, it just vanishes in a moment, just as that spirit comes out and, it will not be lasting. So that which is beneficial over the long term. So if you want to be dharmic, have a long-term perspective, not a short-term perspective. First principle, beneficial to the group over beneficial to an individual. If there is a conflict, you are going to have individual benefit, you are going to have collective benefit. Which one should take priority? And Dharma says, that which benefits the group, tyajed kulasyarthe, gramasyarthe kulam tyajed, gramam janpadasyarthe, atmarthe prithvim tyajed. For the sake of the family, an individual can be sacrificed. For the sake of the village, an family can be sacrificed. For the sake of the country, a village can be sacrificed. And for the sake of the Atman, the whole world can be sacrificed. This is a Shubhashita of Bharatiya culture. So it gives you the hierarchy. How do you decide which one should be a priority and which one should take secondary status? Action to be judged based on your intention. Two people may do the same act, but one may be dharmic, the other may be adharmic. How do you judge? What is your intention? Is the intention pure? Is the intention prompted by prema? Is the intention based on truth? Does the intention lead to shanti? If it is so, it is dharmic. Otherwise, it is not dharmic. So, what is the intention of the individual and how was the consequence planned? That is what defines what is dharma. That which does not cause pain to oneself nor causes pain to the other. That is dharma. So it doesn't say that, you should do it for the others and you can be at a loss. It says you think about yourself also. And that is the knack. How do you cultivate the skill that I should not be at a loss, I should not be pained, as well as the other person also should not be inflicted with pain. This is the key function of a human being, the dharma of man. Just as, what is the dharma of sugar? To be sweet. If sugar gives up its sweetness, it will not remain sugar. What is the dharma of ice? It is to be cool. If ice gives up its coolness, it cannot be ice. Similarly, Swami would say, what is the dharma of man? The dharma of man is to unify thought, word and deed. Manasekam, vachasekam, karmanekam, mahatmanam. That which enables you to remain calm, unruffled in all circumstances, that is dharma. And this is the biblical, classical advice. Do unto others what you want others to do unto you. And similarly, do not do unto others what you don't want the other man to do to you. So these are 7 sutras, 7 mantras, 7 guidelines which Bhagwan has given in his discourse. Volume 2, Chapter 44, Sathya Speaks. Read it in original and it will provide you as guidance, because remember, no university in the world can prepare you for life situations. They can only orient your thinking. They can only build your capacity to think and to think righteously, but they will not be able to anticipate what specific circumstance you are going to face in life. So therefore, guidelines become that's how the guidance has been provided by all the Dharma Shastras of India. Now, what is the true worth of money? See, sometimes we do not recognize the relativeness of money. So I just made a small contrast. Money can buy a house, sure. Can it buy you a home? Money can buy you medicines. Can it buy you health? Money can buy you a cushy bed. Can it guarantee good sleep for you? Money can buy many friends. Swami would say, you know, when your father is in job and your money is full, your pocket is full of money, there are so many friends around you, like frogs in a pond. The moment father is retired, money has disappeared from your pocket. All the friends, like the frogs deserting the empty pond, their friends also disappear. So they can buy you many friends, but can it buy love? Money can buy many things. Can it buy you peace of mind? Money can help build a place of worship. Can it get you God? So think about money. As again I underline, it's good to have money, but how you earn that money and how you use the money is where you reflect your dharma. Now, this is another point which Swami has made. Claimants, if you earn money in a wrong way, there are 4 claimants for ill-gotten money. One is the government. You'll be always afraid of the government because they'll be after, oh, some taxes we have to collect from this person. The thief. Fire. There'll be some natural disasters and, you know, you will lose property in that. And finally, disease. So, that's why Swami says money comes and goes. Don't be attached to money. Earn money in a righteous way at every level, and you will always find yourself on the right track. You know, there was this industrialist. He was a very close friend. We heard it directly from Swami. I don't want to name the person. He was a close friend of the Shah of Iran. Now, the Shah of Iran was head of state, and he had an apprehension. What if one day, you know, tomorrow I lose, something happens to me, I lose the kingdom, I lose my life, my family should not be affected. So he had this good Indian friend, industrialist, so he gave him a big chunk of money. He said, please keep it in your custody. If anything happens to me tomorrow, please pass it on to my family. And sure enough, the Islamic revolution took place in Iran. The Shah lost his life, though his family escaped. But now the friend thought, my friend is no longer there, and I have so much money. Why should I pass it on to him? He gave a word, and he went back on his word. And this is the insight which Swami shared with us. You know, he took away his friend's money and did not fulfill his promise to his friend, what he had given a word. His own son, one day, committed suicide. He had such a huge business empire. Nobody to inherit it. Nobody to inherit it. See, this is how the law of karma works. So, Swami has taken examples from people in his own times to educate us how we should lead our kind of life. So, nothing wrong in earning money at any level, but not in the unrighteous way. Now, ethics in raising funds. So these are 2 facets which I thought I will just touch upon. And I want, because this is the folklore of our university, the birth of Anantapur College. And this is much before the Central Trust was born. And at that point of time, Swami had to deposit 2 lakh rupees to the government to get the college registered. And there was no funds. And at that juncture, there comes this businessman and he wants to offer some money to Swami. And this was shared with us by a very ardent devotee of Bhagwan, Mr. Indralal Shah, who happened to be there. And this man wants to give the money to Swami, and Swami is, says, no, you can use the money in your own way, and all that up and down, negotiation was going on. Finally, Swami did not accept the money and sent him away. And all the time, Mr. Indulal was, burning inside. Swami, we need desperately that money. Please accept it. So finally, when Swami, sent that man out, Mr. Indulal Shah could not resist, and he said, Swami, we need the money. Why did you not take that money? We could have, registered our college. And Swami said, Indu Lal, did you see with what attitude he wanted to give his money? How can I take that money when he is having that kind of attitude? And so that's how Swami persuaded him. And this was a personal, in a conversation he shared it with us. And then finally, little, the money kept accumulating in the bank account. Just when the due date came, it just tipped over 2 lakh, and Swami said, pay the money. And that's how Anantapur College, the first college, not the university, I'm talking way back in 1968 when the college was born, how the college started. So Swami used to be so careful how he raises funds, even for his projects. CRY. Now you would have heard about this organization. It's called Child Relief for You. This was an instance which was shared by one of our students. He finished his undergraduation and he joined a company which was not directly CRY, but it used to raise funds for the purpose of CRY's charitable activities, basically child relief. And in course of his work, he had to meet a lot of rich people. He had to go to their homes, talk to them, persuade them, please donate. So one day, this was an insight which he said, sir, people are so rich, but rich people are so sad. This was his personal experience. You go asking, see, these children, they need this help, this support, and he's telling the rich people, and the rich people would pour their woes, what their sorrows were on his self. So this was his personal insight. People have so much of money, but there's so much of sadness. And he was able to raise good funds for the organization. One day he was talking with his colleagues and they laughed at him. He said, what? What are you talking? Most of the money that we are raising is for ourselves. He said, what do you mean? Yeah, 90% of the money is for ourselves. And only 10 rupees, 100 rupees you raise, 10 rupees only is going to the CRY. He said, is it so? Yes, it is so. He couldn't believe it. He went to his CEO of his company and he said, sir, is this true? He said, yeah, it is true. And then he said, sir, how can you do it? Because he was going every home and pleading and appealing to every family member, please donate, this is for child welfare and how many people will be benefited. He could not take it that 100 rupees I raised, 90 rupees is just for our company and only 10 rupees is being shared. And the CEO said, hey, who's paying you your salary? He said, sir, I can't take it. I resign. And immediately he left the organization. And of course, it led to a great backlash in his family. They said, what are you? You're a fool. It's such a good salary and such a good position and you have given it up. He said, no, I cannot. My heart does not permit me to do this kind of a work. I am going and talking so much to people and this is what is happening. And one day, he was going somewhere on the street and he bumped into the CEO of his company. He himself had been sacked. The company had to shut down. See, when you build your company, when you build your institution on adharmic principles, see, what is the adharma here? When you raise funds, how much cost is incurred in raising the funds? You're raising 100 rupees, 90% is going in just administrative costs. Only 10% is going to meet the goals of the organization, the purpose for which you're raising the charity. And that is adharmic. And that's why in charitable work, one of the most important things, parameters which is assessed is what percentage of the money raised is actually used for the goals of the institution. How much is your administrative expense? This is one of the important metrics by which charitable organizations are assessed. For example, you may remember Warren Buffett, when he had accumulated so much of funds, he wanted to donate it. You know what he did? Instead of starting his own charity fund, he donated it to the Bill Gates Foundation. It was such international headlines at that point of time. And he was an investor. He said, if I set up my own foundation, I have to again employ a huge administrative setup to implement the charitable work. Here is an existing organization. They already have everything in place. Whatever money I give them, and so this is how two people who are very unlike each other. Bill Gates and Warren Buffett were sort of poles apart as per Bill Gates' own confession. But Warren Buffett had no qualms in issuing all his charitable donation to the Bill Gates Foundation. So how you raise money and what expense control you keep on that. Taxation in India. Vidur Niti in Mahabharata speaks how people should be taxed. And you know, the analogy which it uses is just take as much from people by way of taxes as a honeybee takes nectar from a flower. This is Vidur Niti in Mahabharata. Believe it or not, in the 1970s, the highest tax bracket in India was 97.5%. You earn 100 rupees, 97.5 rupees you have to give to the government of India, 2 rupee 50 paisa you are permitted to keep with yourself. Can you imagine what's going to happen with all that? Extraordinary tax evasion. And this was narrated to us by our professor in taxation when we were doing undergraduate in the university. He was a former retired commissioner of income tax, Mr. Jagannathan. He was an accountant in our hostel. And this is one day he was sharing with us, I had a conversation with the finance minister because they were part of the same ministry. And the finance minister was asking him, you know, how do we solve this problem? So much of tax evasion. And this is the story where Mr. Jagannathan narrated to the finance minister. He said a father wanted to divide his property to his two sons. Now he was worried, if I divide the property, either of my sons may feel that, you know, oh, dad loves my other brother more and he gave him more and he gave me less. So he hit upon a plan. He said, I will give this property to you. One of you have to divide the property. The other brother will select which one he wants. So this was his plan. So now Mr. Jagannathan asked the finance minister, he said, sir, how do you think the father, the first son would have divided the property? And the finance minister said, he would have divided it 50-50. And that is how, from that conversation, was the genesis of India's taxation bracket, 97.5% coming down to 50%. And today it is 30%. And tax collections have increased. So there's less of tax evasion today. You lower, you become more fair, the government becomes more fair in taxation, and naturally people are now more inclined to comply with the tax laws and pay their taxes. So to be fair in taxation, right, at the national level. Case of Paytm. Just some moments ago on India's digital payment revolution. And UPI is a classic world-class example which India actually wants to export to the world. When Paytm was a fintech company, but it fell foul with the Reserve Bank of India for a very simple reason that, and it's not that suddenly the RBI woke up and they took action. Please, I mean, that's not how it happens. They gave so many reminders. We find these kinds of deficiencies in the way you operate. And one of the important things which they observed in their operation was that you were not doing your KYC of your customers properly. And so they said that without this KYC, you are, subjecting the country to extraordinary risks. You know, I was talking to one senior banker in one of India's top private sector banks. He also got into problems with the RBI and he was narrating his experience. So the RBI, see, many things happen at the grassroots level. The people at the top don't actually really know what is happening, but their processes should be in place. And so the RBI in their investigations found, and they had to take remedial measures, you know, like a room, there's one single address, the room is just 10 by 10 feet, and there are 10,000 customers of the bank registered with the same address, 10 by 10 feet. So the RBI asked them, what is this going on? How can you have 10,000 people living in the same 10 by 10 feet space? So the bank had to, strengthen its KYC norms, and especially Paytm. See, we must understand a little bit of geopolitics also. So Paytm was substantially financed by Ant Group of China, Jack Ma, and I think, SoftBank. Now, China has made a policy that if there is any Chinese company, they will have to share any data that the Chinese government wants. And that's why in 2020, the Indian government made a rule that, we have certain restrictions on investments being made by countries which share with a land border with India. So with all those kinds of pedigree, Paytm founders should have been careful, but they ignored the kind of reminders that RBI was giving. And one fine day, and people thought, what is this happening to Paytm? I said, yes, there's no such, it's a level playing field. We cannot allow you to create, and especially money laundering. You see, one thing I would just want to mention, sometimes you read, please understand, the Money Laundering Act, if you are having an offense under the Money Laundering Act, it's a non-bearable arrest warrant. You cannot get, sort of this thing, relief from that. It's a non-bailable arrest warrant. So from that point of view, one has to be extraordinarily sensitive when you are dealing with the laws of the land. And that's why in his 60th birthday discourse, Swami gave us 10 guidelines for life, and one of them was to follow the laws of the land. So that is Paytm. Indian call money market. See, one of the essence of the Indian financial markets is trust. For example, Indian call money market averaged daily turnover, I think I was looking at the data 2016 to current, it can 5,000, 6,000 crores. It has gone up even to 40,000 crores daily. And it is basically an unsecured market. Can you imagine 40,000 crores being exchanged without any security? Can you imagine that? Somebody, see, please understand, if you're a bank and I am your customer, I borrow money from you and I don't repay 100 rupees, I have a problem. But if I borrow from you 100 crores, you have a problem. I don't have a problem. You have a problem. And that's why RBI is so careful that, there should be systemic risk in the financial system. There are some institutions which are recognized today as too big to fail. You cannot fail. And we will have extra supervision on you. Why? Because you cannot be allowed to fail. Look what happened to the global financial crisis, 2008. Lehman Brothers went to the government of America and said, please bail us out. Sorry, we will not. And they didn't imagine that it would trigger a global financial crisis. So the Indian call money market, why does it trade such volumes without any security? Because it's a telephonic market. Today it's a cell phone market. Because it works on one principle: my word is my bond. And I will never go back on my bond, the word that I have given. Why do they do it? They may borrow huge money from elsewhere, but they will not default in the call money market. Why? Because today if I default, tomorrow I cannot exist in this market. I cannot afford that. Because it is my market to go to when I am in need of funds. Imagine such a huge financial market, absolutely unsecured, even though only public sector banks, cooperative banks, and some primary dealers are participants. The 3 C's of credit: capital, capacity, and character. Sometime in the early part of the new millennium, I felt I had lost all my moorings in banking, because the way private sector banks were lending, no questions asked. Please, through an agent, just credit growth, going after credit growth without any precautions. The 3 C's of credit: capital. How much are you willing to invest? At least 10%, 20%? Capacity. Do you have the capacity to productively use this credit? And finally, a character. We had the managing director of one of India's premier multinational banks, and there was this industrialist, he said, these are my papers and please give this loan to me. And he was not willing. He was not willing to oblige. Actually, he was the alumnus of our university, and he was sharing. He said, I will not give this money to you because you don't smell right. I smell that you are mischievous. I smell that you will not return this money. And because I have suspicion on your willingness to repay, I will not give you the credit. So it is so essential how, you raise your funds, how you use your funds. I talked about personal finances, the example of the CEO of HDFC. Take the Silicon Valley Bank. We thought global financial crisis. Now in the financial world, there are no more crises which are going to be happen, and we have learnt all our lessons. And lo and behold, Silicon Valley Bank, the largest bank in Silicon Valley, the IT capital of the world, right? It is the banker to all the technology companies in the United States of America, 16th largest bank of United States. It made one fundamental error. It earned so much around, I think, 2020 or 21. There was a huge venture capital financing of startups, and so much of startup funds flowed into this particular bank, and they didn't know what to do with so much of money, so they put a lot of money into mortgage-backed securities, government bonds, and you think they are very safe. And we had the pandemic. Post-pandemic, the interest rates increased from 2.5% to 5%. Ukraine war came, and from 5% in America, the interest rate jumped to 9.1% with 9.1% inflation rate. Federal Reserve had no option but to increase their interest rates. And when they increase, what happens to the previous existing bonds? The bond prices fall. And so as long as you're holding them to maturity, you're not selling it in the market, no problem. But at one point of time, they felt that they needed to raise extra capital, extra equity capital, extra debt. And the moment they announced it, there were so many of the depositors said, you don't have money? They lost confidence in the bank. In one day, 24 hours, 60% of deposits of this bank were withdrawn. Can you imagine? This is a run on the bank. No banker anywhere in the world for any time will ever be able to face that kind of a run. When there's a loss of confidence, a run on the bank, no banker will be able to satisfy you. And therefore, that was the collapse of Silicon Valley Bank. So what kind of risk management do you do? See, you cannot practice values, you cannot practice dharma if you do not equip yourself with professional competency. Banking at today's time, bank management at the top level, corporate level, is only risk management. It's not deposit and lending. Don't be mesmerized by all these graphs. That's not banking. Basel III norms are so stringent today after the global financial crisis. So case of Silicon Valley, budgeting, now because time is a little less, I just give you some examples. Case of Wipro. One day when Asim Premji was still at the helm of affairs, he sends an email to all top executives of his company, which was one of India's iconic IT companies. 4 p.m., please assemble in hall number so-and-so. And everybody assembled there. And the agenda for the day is his announcement that so-and-so star performer of a company has over-padded his expense account. He was entitled to some fund, some travel investment or whatever, some bills. He had padded it. He had not spent the money, but he claimed it from the company, and the company felt this is unethical. He said, he may be a star performer, but sorry, it's not acceptable, and he is sacked from this moment. However, the moment you step out of this hall, I don't want any one of you to speak one word ill of him. Our action is taken for his act. It's not for the person. That was Azim Premji. So when the leadership at the top sets the setting for practice of dharmic actions, he said it may be a small amount, that's not the issue. You are not permitted to do this kind of a thing. Today I condone a small act like this. Tomorrow it will become a much bigger thing. The global financial crisis, I mean, we have studied it, I think in your curriculum you would have studied it in much more greater depth. I would like to just mention, when all the top honchos of finance were here, they were expecting that in their interaction with Swami, he would give them a public thrashing. But Swami is like a divine mother, here to point out our mistakes so that we learn from them and don't repeat it in the future. You know what Swami said? He started his discourse in the Kulwant Hall when all these people, top honchos of CEOs of banks sitting there, he said, he took this example of Dharmaraja. He said, Dharmaraja was a good man. He said, he's a good man. His name itself was Dharmaraja. But he had one weakness, and that weakness was gambling. And with that weakness, it was exploited by the opposition, and he lost his whole kingdom. He gambled away all his brothers. He gambled away himself. He gambled away even his wife. And when Draupadi, his wife, comes to a court, these are the questions he asked every member in that court. He said, did my husband gamble himself away first, or did he gamble me later? I belong to 5 husbands. How can one of my husbands gamble me away? Nobody in the court of Hastinapur, from Bhishmacharya, Vidura, Dhritarashtra, none of them could answer her question. But Swami, using that analogy, he said, you people deal with public funds. See, this is why the financial world is very different from a manufacturing industry or from agriculture. There is high risk. You can make extraordinary profits in a very short period of time, but you're dealing with public money. You cannot gamble with it. And that was the message that, he left with all. The great lesson that we took from the global financial crisis is, they say the markets will, operate on their own. We should have free play. For 30 years, United States had a free play of the banking forces. All the rules and regulations had got diluted. For 30 years, one fine day, the bubble burst. And CEOs of companies are going to the President of America flying down to Washington, D.C. in their private jets, and became such a public embarrassment. He said, you're coming to beg money from me, billions of dollars, and you're coming in your private jet? This is beggars. They will come to beg in a private jet. So the hypocrisy of the whole finance world was out in the open, where capitalism means privatization of profit and socialization of costs. So if losses take place, the government taxpayer will pay for it. But if there are profits, we make it for ourselves. So that cannot continue, and that is why it has led to so much of regulations by central bankers, by governments across the world, So I come to my last 2 slides. And these are 2 analogies which Swami gives us. One is, how do you get grace of God? You go to a bank. How will you get money from the bank? You withdraw money through your savings deposit. You have made some deposits. You have taken a loan based on security, or you obtain a guarantor to act as surety for you. These are 3 ways in which you can get money from the bank. How do you get money from the spiritual bank? Every day, good thoughts, good words, good deeds. Keep depositing. God will keep accumulating it in your account. And any point of time you can withdraw. Any point of time you can withdraw. Supposing in this lifetime you have not done anything good, don't worry. In your previous lifetime, you can give security of your good merit of previous lives. Accumulated punyam from your past lives, you can give a security, and God's grace can be granted to you. Swami, I have not done anything good in this life. I have not done anything good in my past life. Get a guarantor to act as surety. Who's the guarantor? Can you get your guru to act as your guarantor? And you know what? Swami, I don't have a guru in my life. I didn't have any guru. What should I do? Faith is your guru. Do you have faith that God can help you? That's true. That faith is your guru. Have that faith and you become entitled to God's grace. Can there be a more graphic explanation of how to obtain God's grace? Profit and loss account, right? We talk of the finance world. You can't talk of the modern finance without incomes and expenses. One thing which we find in this modern finance is that you net your expenses and losses, and what you get is your surplus or deficit. That's how your profit and loss account is prepared in modern finance. Spiritual finance. Incomes, yeah, you do good, you get a credit for it. That is your income. You do wrong, that is your expense. That's your debit. But one thing different about the regular modern profit and loss account and the spiritual profit and loss account is every debit has to have its own consequence, separate from every credit having its consequence. So there is no netting in the spiritual profit and loss account. You have to get, in life, there are neither rewards nor punishments, my dear students. There are only consequences. So with these few words, the last slide, some of Swami's other sayings, don't waste money. Waste of money is evil. He would always tell us. Truth is a value that is relevant in accounts and audit. Especially in these two disciplines, you must practice truth. If wealth is lost, nothing is lost. You can always earn it again tomorrow. You don't have to give up your principles and scruples. If health is lost, something is lost. But once you lose your character, everything is lost. So these are some of my thoughts, musings on this very beautiful theme, which was our conference in 2009, presided by the then governor, RBI Governor D.V. Subbarao, and we also had the former governor, Y.V. Reddy, and a host of galaxy of top honchos from the finance world. I thought it may be a useful topic for all of you, and that is why I chose to speak on this. Thank you, and Sai Ram. So no time for questions, we can take it later in the afternoon.
We thank Sir for sharing his personal anecdotes and reflections. Sir broke down complex topics and delivered an inspiring and enlightening talk. Ethics in the world of finance is the need of the hour. Various crises, in fact, can be attributed to lack of crisis, as Sir rightly mentioned, the 2008 global financial crisis being one of the major examples. Sir beautifully expounded upon the meaning of money, dharma, and various aspects relating to use and misuse of money. We thank you, sir, for this wonderful talk, and I believe our students shall benefit from your wisdom throughout our lives. I would now like to request respected Chancellor, sir, to present Sanjay Sahni, sir, with a token of our love and appreciation.
Meeting him as a student when I was a registrar who was in the selection committee.
As part of the one-day national workshop on Indian financial system prospects and challenges, Arthashastris Club from the Department of Economics had organized an essay writing competition for economic student as well as non-economic student. Today, I have the opportunity to announce the winners of the competitions. The topic for economic students was Indian financial system, prospects and challenges. The first place is awarded to Sai Krishna Chaitanya from First MA. The second place is awarded to Murli Krishna from 3rd BA Economics. And the third place is awarded to Sathu Jalandhar from 1st MA Economics. The topic for non-economic student was role of financial market in economic growth. The first place is awarded to Sumiran Gurung from 2nd MSc Mathematics. The second place is awarded to Manoj Reddy from 2nd MSc Mathematics. The essay writing competition had received an overwhelming response both from the economics and non-economic student. I congratulate all the participants and winners. Now, I would like to invite Sai Swaroop of 2nd MA Economics to introduce various clubs initiated at the Department of Humanities and Social Sciences, Department of Economics.
Om Shri Sai Ram, offering my most humble salutations at Swami's Divine Lotus Feet, revered Chancellor Sir, esteemed dignitaries, the Head of Department of Humanities and Social Sciences, and all my dear brothers. A loving Sai Ram to everyone. I am delighted to announce that this academic year we have formed and identified 3 clubs from Sai School of Economics under the Department of Humanities and Social Sciences, namely the Dialogue, the Arthashastris Club and the Profits. The main intention behind launching these clubs is to create a vibrant community dedicated to foster a deep interest in economics and its practical applications across various fields. Our primary objective is to cultivate a platform where students can actively engage themselves in economic discourse and understand its profound impact on the society. Firstly, we have the Dialogue Club. Under this club, we are having dedicated sessions to discuss on various socio-economic issues, and we shall be having case study presentations by external resource persons. We are also planning to have pep talks which will focus exclusively on simplifying and analyzing economic documents like RBI monthly bulletin by encouraging participants to present key insights and we shall also have short presentations from the domain of behavioral economics and finance. Moving to the second club, we have the profits. Under this club, all the interested students from economics and as well as non-economics background are provided with a platform to learn the basics of personal finance, and weekly articles will be circulated among students, demystifying and simplifying the complex financial terminology so as to facilitate their understanding. Also, students will be introduced to various aspects of investing, thereby empowering them to make informed decisions as far as their finances are concerned. Lastly, we have the Arthashastris Club. This club is responsible for conducting monthly competitions such as essay writing and poster making competitions, and also conducting various workshops and seminars. Additionally, they are also entrusted with the responsibility for the management of notice board, wherein the club would regularly put up various articles and reports. All the three clubs will have a common newsletter which will be circulated across the campus on a monthly basis. All these clubs provide a platform to students to explore their interests, contribute ideas, thereby enriching themselves in the domains of economics and finance, and each one is provided with space to thrive and flourish. I invite each and every student to actively participate in all the club activities and make these clubs a resounding success. Thank you, Sairam.
I thank all the participants for the morning session on the one-day national workshop on Indian financial system prospects and challenges. We shall meet for the post-lunch session at 1:30 p.m. I request all the students to be seated by 1:25 p.m. Thank you. Jai Sai Ram.